Mike Gapin of Bank of America commented on that as well. The reaction function remains asymmetric. The Fed will cut in response to weakness, but will not turn more hawkish if activity remains strong. That's a really important shift over the last few months.
And it's turbocharged the easing in financial conditions that has been so incredibly aggressive. Again, though, this raises the question, have we entered a new regime where inflation is naturally higher? Bill Dudley, in a column today, and we're going to be speaking with him, talks to the fact that maybe it is substantially higher. And if that's the case, does the symmetry have to shift a little bit on the Federal Reserve? Because they haven't dealt with this question, but if you are dealing with more inflation than we were pre-pandemic, does that risk become more material? That if they don't really either keep rates high long enough or cut rates, that they could be Arthur Burns?
Let's get to the Dudley spread. It's important. Did you almost call him John Burns?
Yeah. Almost.
Would I be a dovish Fed chair?
I don't know. I'm not sure.
Let's not go there. Let's talk about the Dudley spread. The Dudley spread right now is where the market is for long-term neutral, which is 3.5, maybe even close to 4, and where the Fed is, which is still with a 2 handle. I just think the Federal Reserve doesn't know, so doesn't want to engage in the debate just yet, and has just left that long dot there, and it's going to leave it there, maybe for a number of months.
It raises, though, a really important debate. Mohamed El-Erian has been out front on this. Does this Federal Reserve need to have some thesis, some sort of driving thesis, to not let a market and an economy get away from it? Because all of their actions act with a lag. Do they have the luxury of waiting until they see what the actual new landscape is? John Stolf is saying very much, yes, they do. They're doing a great job. Other people, the jury's still out. And that, I think, is really what's whipsawing markets and really not understanding whether good news is good news or bad news is good news or good news is bad news, et cetera.
Et cetera. John Stolfus thinks we're in a new equilibrium where we might be able to live with 5% interest rates, that you wouldn't see any damage to the equity market if 10-year yields hit 5, 5.5. You might see some indigestion, but the damage won't be done until you hit 6. What did you make of that?
The problem with that thesis is, from a financial perspective, it makes perfect sense. If the world were just totally financialized, but you think about the groups and the particular segments of the economy that are more vulnerable to higher rates, and you start thinking, okay, if we have prices that are at levels that were really enjoyed during the financial crisis, during the sort of low rate era, it's going to get hairy for a lot of people, and that's going to start to drag on consumption and a whole host of other things.
Don't you think we're conditioned by our upbringing? Average age of the trading floor right now is what, mid-30s? Something like that? So for a lot of those people, they haven't seen the cycle that John Stolfus is talking about, where he's talking about 10% interest rates, he's talking about 15% mortgages, different worlds. So his view, his bias is, we can live with this. Everyone else is just waiting for the crisis, waiting for the pockets of stress, waiting for the next big bank issue.
But the discussion that you guys were having about house prices, some people might say it's an anecdote. I would say it's actually the key question. That yes, people can live with it, but is there no hangover from all the asset price inflation from zero rates? Is there no kind of, reconciling of price levels with a new rate regime that do not allow those same kinds of prices so easily with free money? And that's still out.
Personally, I think that John Stolfus conversation really revealed the generational divide between, say, the boomers right now and the millennials. The boomers are sitting there saying, well, wait a minute, we had 15% mortgages. And we're sitting there saying, yes, but you could buy a $200,000 apartment in Manhattan with a roof terrace and 2 bedrooms. I'll take your 10% mortgage if I can have the price you paid for your apartment.
This really goes to the key question, right? How far do we have to wash out some of the higher valuations in order to make peace with rates at these levels?
And make peace with the boomers.
Yeah.
Yeah.
Are you trying to?
I was trying to go
getting
there.
Personal.
I'll make peace with the boomers. We got the Dow anywhere? No, we're not doing that. Equity futures on the S&P 500, positive 1/3 of 1%. TK would be so pleased if I did that. Your equity market elevated, trying to bounce. In the bond market, yields a little bit higher, up by a single basis point, 435.73. Coming up on the program, John Balvan of BlackRock on the, quote, mega forces at play in the stock market. Javier Blas of Bloomberg Opinion with Brent hovering very close to $90 a barrel. And Macquarie's Terry Wiseman on why he sees the US data hasn't been friendly to bondholders. We begin with our top story. Stocks just about snapping a 2-day losing streak as Chair Powell sticks to script. John Balvan of BlackRock remaining bullish, writing this. We think upbeat risk appetite can broaden out beyond tech as more sectors adopt AI. More broadly, rising and volatile yields have not disrupted the push higher in developed market equities. That's consistent with our view that mega forces such as AI are key drivers of returns now. John, I'm pleased to say, joins us now for more. John, we'll get to the stock market in just a moment. I just want your views on Chairman Powell yesterday. Given the economic data we've seen so far, would you describe some of those data points as just bumps in the road in the same way the chairman has?
Well, I think this is a long road. So if I look at the first stretch of that road, I think it's a bump. So we think inflation is going to be showing progress towards 2 over the next few months. The Fed is data dependent. They're not forward looking. So they're going to be lured into we've solved inflation. That's going to be the story. That's part of the reason why we are kind of constructive on risk for now. And I think that's going to be the story. They'll cut. This is a Fed that is boxed himself in December to be to cut at some point this year, some point soon. I think the bar not to do that is pretty high. I mean, we can debate whether this is the right stance, but it is the stance. So as a result, a bit of progress on inflation will cut the narrative for them that there's bumps, and they'll be in a position to cut. So I think that's the story for the next few months, and that's why risk assets are set to continue to perform.
John, the story we've had over the last few days really is how to interpret the moves in bonds, the moves in commodities with regards to equities. How are you interpreting those moves?
Yeah, I think the first point to make is we very much believe we're in a new regime, right? So we're pro-risk right now. I think this has room to continue, room to run. But it's a very different environment. The idea that we're going back to true immaculate disinflation to the great moderation of pre-pandemic, I think is not happening. And I think when you look at the bond volatility that we're seeing, it continues. That was clearly the case of 2023, but like even this week, massive. I think that's the biggest evidence we have that this is not, back to the old regime. So I think we're seeing, a lot of volatility in the macro narrative. It takes a little bit of data to come in to lead to very significant reaction, as we've seen. And then lo and behold, we're at the same point as we were like a week ago before the PCE in terms of Fed expectations. The only thing that has really changed is long-term rates that are set at a higher level now. So I think it speaks to this environment where we can very much see the Fed starting to cut, but at the same time, don't expect long-term rates to follow suit and move down. I think we can very much see a Fed that starts to cut rates. It's going to be only a couple anyway. And then we're going to, at the same time, see rates that are stable, long-term rates that are stable or even go higher from here.
Which is the reason why you've been focusing on the short end of the yield curve. We had John Stolfus earlier this morning on who said that stocks could continue to rally as long as 10-year Treasury yields didn't reach 6%. Do you agree with that? That if we had 10-year Treasury yields north of 10%, that would not be, north of 5%, excuse me, that would not be a problem for equity valuations?
No, I wish that's the case, but I find it hard to relax about this. So I think if we were really of the view that we're going to 6 in the short order, like over the next year, 6% 10-year, very difficult to see equities that sailed through this. So, I think we've seen some evidence of that, right? Go back to October of 2023, last year, we went north of 5%, and that was a very different narrative, felt very different. So, I mean, over a course of 10 years, we might reset to a higher rate environment and realize that we can live with that. But I think the journey there will be one where equities will feel more than bumpy.
When people talk about a new regime, a lot of guests who've come on surveillance talk about their investments in the energy sector, as well as just commodities in general, that any AI adoption has to come with hard infrastructure investments that have not been fully accounted for. How much is BlackRock kind of adhering to that and really overweighting a host of commodities?
So there is a massive restructuring of the economy that is happening. We think there's AI is one big piece of it, but we see 5 big mega forces. Demographics is going to lead to a big change in spending pattern in developed economies. The rewiring of geopolitics means that we have a different organization globally that requires adjustment, infrastructure. We have the transition, the energy transition, and we think finance is restructuring itself as well. So big trends. All of them require adjustment, and these adjustments, I think, have to involve some kind of very significant investment. I mean, if you only take the transition, the energy transition, that's by itself, a huge amount of investment. I think AI is in the middle and interacting with that. So, I think infrastructure is a huge part of the story of the year to come. Even if you don't have like very bullish growth expectations, we still need a lot of investment, infrastructure investment. So, and yes, that's going to support commodities. I think it's harder to draw a link to this need for investment and what it's going to mean for commodities. I think it's a much more complex story, but there is ultimately we're going to be drawing more on commodities as we deliver on these investments.
You mentioned this changing geopolitical map. We have the Secretary of the Treasury over in China, and she's talking about that they don't want to completely decouple from China. It's just about diversifying. Do you buy that? And if it was to be a decouple, how does that change your thesis?
Well, I think decoupling, complete decoupling, is even if that was the objective, is not realistic, right? I mean, we're intertwined in very fundamental ways globally, and so fully decoupling will not even be on the table. So I don't see necessarily a lot of information in a comment like this, right? I mean, it's kind of a straw man that is unachievable. But there is a trend. I think the most important thing for me is that we are fragmenting. There's a distanciation that is happening. The question is, how that's going to be navigated? But in the meantime, aside from the politics and those trips, I think investors and companies globally are adjusting and making plans that are accounting for the fact that the world will be more fragmented than it was. And I think that's one of the big mega forces that is happening and is affecting decision even as we speak.
Jean, if that's the case, do I want to have a bias towards small caps away from multinational big caps?
I mean, you could eventually see that logic playing out. I think for now we still think that more from a tactical basis that you would need to have more conviction on a growth spurt that is lasting more than a few months to start to broaden your views on small caps. I think that's going to be more of a story about the near-term growth than it is about fragmentation. But if you think on a 10-year basis, then I can very well see a story where you see more localized companies, small caps, being beneficiaries of this geopolitical megaforce.
That's one to watch. Jean, you're one of the best. Thank you. Jean Bavin there of BlackRock on their latest views on the equity market and a whole lot more. Equities right now, positive 1/3% on the S&P with your Bloomberg brief. Here is Yahara Hakez. Hey, Yahara.
Hi, John. Paramount Global is getting closer to a deal to merge with David Ellison's Skydance Media. Sherry Redstone, Paramount's controlling shareholder, has reached a tentative agreement to sell her stake. That's according to people familiar with the talks. Shares of Paramount have been under pressure for years, reflecting the company's loss of traditional TV viewers and costly efforts to develop a streaming service. The media company had a market value of nearly $9.2 billion at yesterday's close. TSMC has resumed operations just one day after Taiwan suffered its worst earthquake in 25 years. The company saying its most critical chip-making equipment was unharmed and that it brought about 80% of its machinery back online within 10 hours of the earthquake hitting the region. A small number of tools at facilities were damaged, but TSMC says it's deploying resources to ensure a full recovery. TSMC is the leading producer of advanced chips for both Apple and NVIDIA. If running 26.2 miles wasn't hard enough, New York transportation officials want runners to pay bridge tolls as well. That's according to the New York Times. The MTA is demanding roughly $750,000 in lost toll revenue stemming from the closure of the Verrazano Narrows Bridge for the annual New York City Marathon. The organization that runs the marathon has yet to agree to that fee. That's your Bloomberg Brief. John?
Yahara, thank you. Do you want to weigh in?
Yeah.
I'm not saying a thing.
I think it could be an active part of the relay, just for put in the money, keep running.
The MTA said taxpayers cannot be expected to subsidize a wealthy non-government organization, but how much money does the marathon make the city?
I don't know. It's getting ridiculous. Don't they want us to walk everywhere?
Exactly.
Right? Isn't that the whole point?
I think it could be an active part of the exercise. Like it could be a good exercise for the arm.
I think
or put an easy pass on your forehead.
It's just ridiculous. Up next on the program, Treasury Secretary Janet Yellen touching down in China.
We have agreed that it's important to both of us that we don't want to decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field.
A conversation up next, live from New York. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Live from New York, equity futures on the S&P 500 positive by 1/3 of 1%. Yields higher by a single basis point. Your 10-year 436.13. All eyes on crude over the last couple of days, settling down just about unchanged, 85.39. Under surveillance this morning, Treasury Secretary Janet Yellen touching down in China.
We have agreed that it's important to both of us that we don't want to decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field. We went for too long with too little communication, and misunderstandings developed.
It's the latest this morning. Janet Yellen landing in China in the last hour. It's her second trip to the country in 9 months. This visit coming as Chinese leaders are pouring money into manufacturing, focusing on new industries such as electric vehicles, batteries, and renewable energy, in a search for new sources of growth for the country's slowing economy. Joining us now is Isaac Boltanski of BTIG. Isaac, can we pick up on that line from Janet Yellen, that we've had too little communication and misunderstandings developed? Where are there misunderstandings currently?
Well, just about everywhere, I would argue. You know, look, with all due respect to Secretary Yellen, I would describe her comments thus far as a noun, verb, word salad. It's sort of a rehashing of all of the same commentary that we've heard for years regarding competition and decoupling, which I agree with your previous guest, in and of itself is a straw man argument. And I think that we've got to look past this and say that the goal here from the Biden administration is the same goal that we've seen for its entire term thus far, which is to keep geopolitical tensions with China range bound. They do not want to see a flare in those tensions running into November. And I think that's ultimately the goal and all that we should expect from these talks and the future talks that I think we'll see over the next few months.
Isaac, though, when it comes to Yellen, we have seen her shift more towards leaning into national security than economics. I don't know if this is just her towing the company line and moving in a little bit more to what Jake Sullivan, Catherine Tai, and what they think. But is China getting a different Yellen on this trip in that sense?
Sure. Look, I think we can agree that she is pushing back on China's incredible, unprecedented.
I think we lost the connection there. Isaac Boltanski there of BTIG. Going to do our best to reconnect. And I agree with Isaac. We've heard a lot of these lines before from the administration. I want to go back to a conversation we had a little bit earlier this morning. We were talking about the same thing with Brian Deese, National Economic Council Director. The tariffs were under review. The tariffs are still on. In fact, now we're waiting for additional tariffs on EVs after what we heard from the administration a number of weeks ago, and we're still waiting.
Additional tariffs potentially waiting in the wings, and also the Commerce Department is going to be looking into the connectivity of these EVs. Again, to Lisa's point a few weeks ago, national security doing a lot of lifting when it comes to potentially what is also a politically fraught moment for this administration ahead of an election, which is making sure they shore up those union jobs. What the administration wants to do now is just keep a lid on this relationship.
I'm happy to say that we sort of shook up the screen and Isaac is moving again. Isaac Boltanski at BTIG. Isaac, you froze just for a moment. We'll continue the conversation. We've been talking about the potential to put tariffs on EVs, Chinese EVs. How close do you think we are to a decision on that?
Look, I think that we need to, as an investment community, understand that there is going to be immense pressure to not put overly onerous tariffs on any of these EVs this year. I think that there's going to be a slow build later this year, second half of this year. I expect there to be a lot more chatter around it and actual movement on the imposition. But it's a 2025 story to me. No matter the outcome of the election, I think that we start to see some of this China hawkishness that has really come to define both parties, moving from rhetoric to reality, no matter who wins. But I think right now we've got to keep in mind that the Biden administration's #1 goal from a geopolitical perspective is to do no harm with China, as it's still trying to figure out what's next in the Middle East in particular.
How much is this really due to the U.S.'s reliance on China for a lot of commodities, in particular having to do with the green energy policies?
Yeah, I mean, that is why your previous guest comments on the impossibility of decoupling are so insightful. It's just an impossibility given the complexities of our broader economy and the needs, especially on the commodity side, when we think about our goals for clean energy and green energy, which are not going to slow down anytime soon. And so my sense with all of this is we've got to look at this as not just a singular issue, but a game of 3D chess, where the Biden administration truly wants it to remain range bound regarding the geopolitical tensions, because there are meaningful ways for retaliation to hurt us in avenues and areas that we're not fully prepared for. And that's what happens in these retaliatory spirals, as we learned during the Trump administration.
Isaac, if rhetoric turns into action, where do we stand right now in terms of TikTok being banned or divested?
So this is one of the topics du jour in Capitol Hill, and it's an interesting one in so much as I would say that there is broad bipartisan support to ban the app TikTok. It's just there's no agreement about how to do it. It's kind of similar to the federal budget, which we could talk about too. But here's where I am on TikTok. There was a House bill that passed. I think that House bill is going to be slow walked in the Senate. I don't think Democrats truly want to ban TikTok right before the November election. I think they're going to slow walk the bill, and it's going to be a risk again after the election. I think we're looking for the lame duck for that to possibly be included in a China bill or in a annual defense bill. So I think it's going to get quiet the next few months, but it's going to pop up again around the election and after the election.
We don't have time to talk about the deficit. We need a few hours for that. Isaac, I've only got a minute. I do want to understand, I think the TikTok episode was really instructive, possibly very instructive, for the former president's views on China and how he's going to deal over certain issues. Isaac, what did you glean from that about how he may govern next time around?
Sure. And look, I think that one of the things that many of us forgot regarding TikTok and President Trump's disdain and original stance on TikTok, that was just part of his China strategy, to the extent that there was a broader strategy. The pushback on TikTok was not about TikTok for President Trump. Perhaps it was for his national security folks and others around it. But for him, it was really part of the China retaliatory spiral I talked about before. I think that you saw a quick and sudden shift here for a number of reasons. One, he says, was the market share and the competitive dynamics with Facebook. I don't believe that as much as perhaps other dynamics that are in play. But on this one, I think it's just a reminder that if President Trump wins again, we've got to rethink how everything will be done, in part because it's not going to be like last time. He's going to enter this time different, with different folks around him and different agendas at play. And that's one of the reasons, in particular, my clients have been focused on what he would do with tariffs in a second administration.
Interesting. Isaac, thank you, sir. Isaac Boltanski there of BTIG. Volume 2, if we get one, might not look like Volume 1, which is something we've all got to talk about through the next few months. Coming up on the program, crude, close to 90, gold, close to all-time highs. Javier Blas, Bloomberg Opinion, up next.
Trends in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Stocks right now bouncing by 1/3 on the S&P, on the Nasdaq doing okay by 0.4. Likewise on the Russell. I found yesterday quite interesting, just selling off going into the close, even with a bit of reprieve in the bond market, backing away from the highs of the year, away from 440 on a 10-year, back down to about 436.73 this morning. Yields inching just a little bit higher. Still struggling to interpret the relationship between bonds and equities because it's evolved so much, Lisa, over the last 5 months.
I think you're right, and I think that this has actually been the biggest shift, the narrative shift of 2024, which is essentially that higher bond yields are actually a good thing for equities as long as they come with the same kind of growth that can turbocharge earnings. And that's sort of the question mark now is what's that line in the sand at which bond yields become a problem for stocks? If higher isn't necessarily bad, it's just to what?
John Stolfus said 550. Indigestion, maybe. 6 is the problem. 6 is the problem.
And then we heard from Jean Bovin, it's going to be a problem way before. Then we just stress tested that last fall. Here's the question, right? Can we get to a new regime with the price levels that we've implied from the zero rate time? Is that something that we can do without some greater levels of indigestion? Jury's still out on that one.
Beating up central banks is a sport on Wall Street, but sometimes they appear to get it right. The Swiss National Bank maybe got this one right. Cutting interest rates and inflation this morning coming in much softer than I expected. At least you get a much weaker Swiss franc off the back of that because now there is the belief they're going to go again. And maybe they're going to go again.
Do you think they knew this? I think that this is the reason why
inflation ahead of time?
Yeah, they kind of figured that, we could just kind of kick it down a little bit, and they actually want a weaker currency, so this is a positive for them on a whole host of reasons. Is this the line of travel for the ECB as well? And I don't think about this for the Fed. I think about Swiss National Bank and the ECB. They might have a luxury to cut rates much more aggressively than in the U.S. How far can they diverge from the U.S. is now the question, right? Can they continue with a deep rate cutting cycle if the Fed doesn't engage in one themselves?
So we've got Terry Wiseman coming up later, and that's the question I want to ask him. I think the S&P less dependent on what's happening in America. Does the ECB need the Federal Reserve to give them cover? Because based on the way things look right now, growth's not great in Europe, inflation's coming down. I think we asked after we got Eurozone CPI, why aren't they cutting interest rates already? How much cover do they need at that June meeting?
So the chief strategist over at Deutsche Bank said that the ECB can absolutely move before the Fed. However, if the divergence lasts for too long and the Fed doesn't get on board with cutting rates, that becomes a problem. So it's not just when you cut, but the cycle and how deep and how long it goes on for.
The euro, 108.60. Under surveillance this morning, another day, another slew of Fed speakers. Harker, Barkin, Goolsbee, Mester, Kashkari, Musalam and Kugler all on tap, following Chair Powell's message that recent inflation did not, quote, materially change the overall picture. Just how much distance is there between those characters on the screen?
I think Barkin and Harker, when you put them together, they sound very familiar and close. So, I think that it's a good kind of, child lullaby that we could create with this. I don't know.
You've fallen asleep.
I think that when we start talking about the rhyme and the role, look, I am curious to hear whether Neil Kashkari has lunch, of course, with Raphael Bostic, but I also want to know exactly how many of them see the luxury of being able to cut rates without any material change in the data, and whether everything is just a bump in the road. Is there a new threshold where suddenly they start to get more concerned about the recent data?
Everything so far that goes against the grain is a bump in the road, and we'll see if that changes. Treasury Secretary Janet Yellen suggesting the US retains options to protect new industrial sectors against China, following what she describes as overcapacity coming from the country's massive state investments in areas including clean energy. The comments coming as Yellen arrives in China for her second visit there in 9 months. I just wonder, Anne-Marie, what is the objective as the talks start to build between the two nations over again?
The objective just seems to keep the relationship on guardrails, to make sure, and she said this, when you don't communicate, there are mistakes that can happen, there are misunderstandings. So they want to keep lines of communication open. But we cannot exaggerate enough how important this is, one, in an election year for the United States, and two, for China, as they are trying to bring in more foreign direct investment. The most interesting part of what she had to say yesterday was that they retain the right to go further to protect U.S. industry. And that just has this whole debate, again, in Washington, what more is this administration going to potentially do?
And that tees up this story perfectly. BYD is planning to launch its first electrified pickup truck later this year, planning to take the vehicle to the global market. They dominate China, but the company has been pushing into other markets too, in Asia, Australia, and South America, where pickups, as you all know, are very popular. I've got no idea how popular this will be, but if you are in Detroit and you're worried, there's already massive barriers to entry to bring in a truck from abroad into the United States. Can BYD circumvent that somehow by going through Mexico, by establishing some kind of presence in the United States? Because that could be a major threat.
And it's a major threat also to Tesla. This is basically a reaction to the Cybertruck. BYD has, what, a 33% share in China? Tesla, Jonathan, you shared their numbers yesterday. I believe Bloomberg crunched them. It's low double digits. And now they have something that can rival Tesla when it comes to these bigger vehicles that people want. But the entry to the United States is more than 25% in terms of tariffs.
Do we like this? Can we get the official review? Can we get the picture back up?
I knew you were.
Are these official colours? Or are these those? Is this like camouflage? Is that the camouflage
to go around? It looks like the fire emoji. It looks like the fire emoji. Think? Yeah, right?
I'm trying to work out if this is the camouflage or actually a real colour.
Camouflage
you know how sometimes you take those new cars, get driven around just to test drive them.
Yeah,
they get driven around in that camouflage,
that
black and white.
No, this isn't camouflage.
That's the real deal.
I think that maybe this is catering to what they think American tastes are. And I think that it's got your name all over it.
Okay, maybe not. Let's turn to this. Crude trading near a 5-month high. Brent coming within a penny of $90 a barrel on the heels of OPEC reaffirming supply cuts and amid rising geopolitical tensions and increasing demand. The brilliant Javier Blas of Bloomberg Opinion joined us now for more. Javier, let's talk about what's happening with crude. And I want you to help me understand just how much appetite is left in Saudi to keep those barrels of oil off the market.
Well, at least another 3 months of production cuts from Saudi Arabia. They want oil as close as they can to $100, and they are pushing for it. I have argued that OPEC could have traded a bit of pain in terms of lower prices, perhaps towards $75, $80, and release production starting in this quarter, in the second quarter. But OPEC just decided the opposite, and they seem to be really wanted to tighten the market towards $100.
This is actually really important, Javier. Let's sit there. They want to tighten the market over $100 a barrel. Is this political, or is this because they want to issue some new securities and want to cash it at a higher rate?
They want the oil. I mean, they see it as business. Perhaps also good politics for them. I mean, let's not kid ourselves. I think that the Saudis will prefer Donald Trump in the White House to Joe Biden. But this is about business. This is about money. The Saudis really need the money. And also they see $90 oil as very similar to what used to be $70 oil. They look at the cumulative inflation around the world and say, look, my barrel of oil doesn't buy me much goods today that compared to 5-10 years ago. I need to adjust prices for that inflation.
This is fascinating, especially at a time where earlier this year and last year, U.S. oil production really overwhelmed any supply cuts that we saw coming out of OPEC Plus and created lower prices. Are we basically inferring here, based on pricing where it is, that U.S. oil production cannot offset some of the cuts that we are likely to see ongoing with the OPEC Plus members?
I think it's clear that American oil production will grow this year at a lower rate than it did last year. Last year, it was a big surprise in terms of production. But what is really surprising many on the market, and I have been saying that the demand side is fine for the last 18 months, is demand, oil consumption growth continues to be quite healthy going into the new year, into 2024. We are now seeing more people revising the numbers higher. The market was around 1.2 million barrels a day of annual consumption growth only a few months ago. Now the consensus have moved into the 1.3, 1.4, or some people even higher than that. So the demand is there, the demand growth is there. American oil production will grow this year, certainly, but probably we are going to need a bit of extra production from OPEC coming into the second year if we want prices to come down. If OPEC keeps the production as it is now, then we will move prices higher towards that $90 to $100 range.
And that's going to mean higher gasoline prices. Javier, if you're, say, Amos Hochstein, and you're going to be talking to the Saudis about what the summer looks like, do you think there's a chance they say, we are going to tap the SPR, or you can release more oil? What do you think the Saudis would want to see?
I think that probably the American officials will say, you need to do what is right for your country. We'll do what is right for our country, and we will not want to see prices getting too close to $100 in a scenario where we also need inflation to come down so the Fed can help the economy. What the reaction of the Saudis is going to be, I don't know. I will mind that there's going to be pressure from other members of OPEC, and particularly thinking about the United Arab Emirates, to start soon releasing production into the market to avoid overheating. And also OPEC is on his interest to release production and not to effectively subsidize future growth of American production.
Javier, given we've seen an uptick in the geopolitical risk in the oil market, how vulnerable are Iranian barrels of oil right now?
Well, they will be vulnerable if the U.S. decided to really enforce those sanctions that it has on the country. But what we have seen from Washington over the last 18 months has been that there is very little appetite for the U.S. to really enforce the sanctions, or perhaps China can bypass completely those sanctions. But whatever is the reason, what we are seeing is that Iranian oil production remains quite robust, and his oil finds outlets, particularly in China.
Javier, you've been covering this asset class for a long, long time. I just wonder what you make of what's happened recently. The breakout we're seeing, not just in crude, we're seeing it elsewhere as well, in cocoa, seeing it in precious metals, silver over the last few days, the last week, gold as well, all-time highs. Javier, how would you frame things for us at the moment?
And don't forget about olive oil, Spanish olive oil in particular, very expensive.
You want to go back there, huh?
Look, a number of commodities have gone up, and I think it's very interesting to see the strength in global consumption of those commodities, particularly in the age of fighting against climate change, particularly oil. But a number of others remain weak. I mean, gas prices have come down in Europe, electricity prices have come down in Europe. So I think it's a mixed bag. If you look at agricultural commodities, certainly cocoa, and I'm a lover of chocolate and Nutella. We are worried about high cocoa prices, but if you look at a number of other agricultural commodities, be it corn, soybean, rice, are coming down. So it's a mixed bag, but I think that what is important is to focus on the fundamentals of particular commodities, and commodities where there is a cartel force, like on oil, or where there is potentially supply shortages coming in the future, like copper. Those commodity prices are high, and probably they are going to remain high for the foreseeable future.
Elisa's got a really interesting story to tell about Spanish olive oil pretending to be Italian, which is amazing.
Well, that's actually completely the opposite. No, it's the opposite. That Italian, they put the names on it, right?
Yeah.
And then it's Spanish olive oil because people
Pretending
think
to
it's
be
prefer because because people would prefer to buy Italian olive oil.
Yes, that's what I'm getting at.
They've done a better job with marketing, and yet
you just think it's marketing.
Well, I don't know. I mean,
oh no, it's taste.
I mean, I've actually gone to an olive oil tasting experience with Spanish olive oil.
What was that like?
It was quite. Was
Javier hosting?
Yeah.
He also likes Spanish wine.
Javier, I know you've got to go. Thank you, sir. Javier Blas of Bloomberg Opinion. Thank you very much. On olive oil and what's happening with commodities. It's been quite a breakout over the last week or so, particularly in precious metals.
The interesting thing, it's different, though, depending on the commodity. With olive oil, it had to do with droughts and weather issues in Europe. With respect to chocolate, it also has to do with weather issues and the fact that, and by the way, Nutella doesn't count as chocolate. I would like to put that out there.
I saw you sort of shrug and smack
I don't think that's really, doesn't count.
I'm on the same page.
But I do think that there is a question, and I think that your question was a good one, how much there is a theme here that we can pull together in terms of demand.
Absolutely, and Javier thinks that there is that demand there. The question I still remain is, will the Saudis come in this summer and actually aid the market at a time when it's going to be incredibly political for them to release those barrels?
Well, that's the interesting point. Aid the market, not aid the White House. And I think that's a clear distinction. What would they need to see to give them reason to give aid to the market? What are they looking for? What kind of disruption would be a disruption too far?
They're going to talk about supply and demand. But I think, and to Javier's point, what they would have to potentially see is if prices go above $100 a barrel, that would be a moment potentially for the kingdom to step in.
You're getting closer and closer, very close to 90 in yesterday's session on Brent, 89.99. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Hekes. Hey, Yahira.
Hi, John. Carlyle Group CEO Harvey Schwartz was awarded a $187 million pay package in his first year running the private equity firm. Most of that was about $180 million of stock, which vests over several years and is based on how well the shares perform and how long he stays at the firm. He received a cash bonus of $6 million, which was double the size of his target. Google is considering charging users for new premium features powered by AI. The Financial Times reporting the potential move, which would be the first time Google puts any of its core products behind a paywall. Engineers are currently developing the technology to roll out the service, but executives haven't decided whether to launch it. Google's flagship search engine will remain free. Rock band Kiss is selling its song catalog as well as its name, image, and likeness to Sweden's Pop House Entertainment Group. Sources say Pop House is paying more than $300 million for the deal. The company plans to make a biopic about the group as well as a live music show featuring avatars of the band's legendary members. Pop House already has a live production featuring avatars of Swedish pop group ABBA. That show makes more than $1 million a week in London. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the program, the Fed's waiting game.
If you're the Federal Reserve, why would you even think about cutting interest rates when the economy continues to be really solid? We're looking for signs that those indicators are cracked, and they're just not there yet.
We'll catch up with Terry Wiseman of Macquarie up next on the program.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Stocks on the S&P 500 shaping up as follows. Equity futures right now positive, a third of 1%. Andrew Hummel's The City just publishing base case. Job market continues to weaken. They're looking for 150 Friday. The Fed cuts 125 basis points this year, almost twice the cuts. Currently priced by the market. He's really holding the line on this one, Lisa. He's looking for weakness in this economy.
So is that going to be a good thing for stocks? My argument would be probably not. That if the Fed is cutting for that reason, for weakness, that could potentially be a real problem on the margins. And then you'll have people coming saying it's a Fed put. So if your head's spinning, welcome. Have some coffee, maybe some Nutella, we can discuss.
Hours 2, under surveillance this morning. It's the Fed's waning game.
If you're the Federal Reserve, why would you even think about cutting interest rates when the economy continues to be really solid? Their MO is to sit on their hands, really not do anything until they have to, until one of those indicators starts to crack, right? And we're looking for signs that those indicators are cracked, and they're just not there yet.
Here's the latest this morning. Treasury yields pulling away from 4-month highs after Fed Chair Jay Powell reinforced the central bank's wait-and-see approach. Terry Wiseman of Macquarie writing, quote, the US data hasn't been friendly to bondholders of late. The data causing traders to question the prospect of a Fed rate cut in June and that the FOMC would follow through on its 3 rate cuts this year. We haven't been too surprised by the bond market's response. Terry Wiseman, I'm pleased to say, is with us now. Terry, let's get into the bond market. At times, we've seen this sort of bear steepener come through, the sell-off at the long end, when we've been looking for that rally at the front end. How have you been sort of interpreting the latest moves we've seen across the curve?
Well, I take a relative view of yields across the world, right? Because I think what drives perceptions in the narrative right now is just, U.S. exceptionalism, how well we've been doing in terms of our data relative to the rest of the world. And I'm mindful of the fact that if you look at the last 2 weeks or so, U.S. bond yields in the 10-year space have gone up by about 20 basis points off those lows we saw a few weeks ago. And maybe just immediately after the, Jay Powell's press conference. But bond yields have gone up by only 10 basis points or so. And I think that points to the idea that, when I say that the data has not been friendly to bondholders, it certainly hasn't been friendly to U.S. bondholders, right? The data has been strong in the U.S., much stronger than the rest of the world, and that's the narrative now. And I think it's keeping the dollar, fairly strong as well.
That's what I wanted to get into. Typically, when you see developments like that, you push it through foreign exchange. Would I have guessed 108 on euro dollar, maybe closer to 106? Perhaps?
Yeah.
Why has the euro and other currencies held up so well in the face of that?
Maybe in part because the dollar is already too strong, right? That could be there's a case to be made for that, and that every time that the euro drops, there's a bid. Maybe that's what's keeping the euro in place. But I think that shouldn't dispel or dilute the narrative here, which is that for the last 3 months or so, we've seen in the market has seen a stronger U.S. economy relative to the rest of the world, and it had anticipated going into the beginning of this year. As we went into the beginning of this year, the narrative was about a slowing U.S. consumer, the exhaustion of the pandemic-era savings. That hasn't really manifested in a slower consumer yet, and at the same time, there's continuing disappointment in China. There's continuing disappointment in Europe as well. That narrative can continue to stay with us for a few more months, I believe. And if that happens, we might well see the euro come down again to 105, 106.
When you talk about the narrative, there's a real disagreement right now on whether we're entering a new normal with a much higher benchmark rate or whether we're going back to something that was more normal pre-pandemic. We have Bill Dudley, former New York Fed president, coming up, and he thinks the market's right. They've been betting against the Fed, and the terminal rate is probably going to be around 375. Do you agree? Do you think that we're entering a time where rates just have to be a whole lot higher for a very long time in the United States?
I do, and this speaks to the issue pertaining to the last mile of the fight against inflation and whether we're going to get to 2%, the Fed's target easily or not. I don't think it's going to be easy. There's some forces out there that are structural and they're militating in favor of lower inflation. One of them happens to be the overhang of manufacturing capacity in China, for example. Rents in the U.S. are likely to see their inflation rates moderate. But on the other hand, you have these medium-term and long-term structural issues, geopolitics and the upward pressure it's causing for oil prices, global warming and the prospect that it's going to cause upward pressure on agricultural prices. All of these problems we're seeing in shipping in the Panama Canal, in the Red Sea, now with the Northeastern Corridor, with the bridge collapse. Those things are medium-term, they're structural, right? Maybe it has to do with the outdatedness of infrastructure in the United States. Those are things that are going to keep inflation potentially high. Where we balance out is difficult to say, but one can easily read enough supply-side constraints out there to suggest that that last mile is going to be tough.
We've been struggling with understanding the relationship between stocks and bonds recently, and at what point bond yields become a problem for the easing in financial conditions that we've seen throughout financial markets, but particularly through stock prices near all-time highs. Is there a level, or at some point are people going to say higher yields are going to become restrictive over time? What are you looking for to understand a real trajectory for that relationship?
So it's not the level of yields that matters as much as how fast they get to wherever you think they're going. If we were to wake up tomorrow and all of a sudden we had a massive positive inflation shock in the U.S. and we felt that the Fed was no longer going to ease, let's say, and as a result of that, the yield curve when the inversion went away and we went back to steeping in a normal way with 10-year yields going up, of course it would hurt the stock market. Multiples would be compressed as a result of that. I think one reason that hasn't happened yet, despite fairly high 10-year yields relative to where they were, say, pre-pandemic, is because the market still expects inflation to come down and the Fed to achieve its target, and that we're going to get effectively a Goldilocks economy. Not too hot, not too strong. What the market doesn't want to see is the extremes. Right? It doesn't want to see high yields on the back of too much inflation or too low yields on the back of a presumptive deflation that's going to take place because we're going to have a recession. Being in the middle is what the market wants to see.
Are you convinced the chairman is committed to 2% inflation?
Yes, but keep in mind that on March 20th, during his press conference, he didn't say that he was committed to it in the short term. He said that inflation, he wants to see that target happen over an extended period. I don't remember exactly the phrase he used, but what he meant to say by that, I think, is let's not worry too much about these bumps along the road. We're still going to ease. But that was predicated on the view that the target is not a short-term target; it's a medium to long-term target.
What is medium to long-term now?
I think it's more. I think it's around 6 months. I think that there were enough studies coming out of the regional Feds that suggested that we would get to 2% inflation on core PCE around the middle of this year on a trailing 12-month basis. I think if the Fed sticks to that, I think they would want to see that happen by June or July. In the June or July data, of course, which won't happen, we won't see until the third quarter.
This might sound snarky. Is it a rolling 6 months? Is it just something they're always sort of shooting for 6 months out?
Oh, I think it conceivably can become rolling, right? It's like that when you're on the road and in hot weather and you see that mirage of water out there and you get closer to it, it disappears and it's only a little further back along the road. Yeah, we can see a situation like that. I think here what we're talking about is not so much the data, but the outlook, right? As long as those things that determine inflation are still pointing downward, the market will not worry. But if we get a delay and it's coincident with something that seems inflationary, like a supply shock, then the market will give up on that prospect and eventually we get to 2%. That's what I'm concerned with, by the way. I think the bigger threats out there come from the supply side of the economy, the global supply side, not so much the demand side.
Terry, awesome to catch up with you.
My pleasure.
You, sir. Terry Wiseman there of Macquarie weighing in on the situation with the Federal Reserve, what it means for foreign exchange and beyond. Coming up on the programme, the third hour of Bloomberg Surveillance. Fantastic lineup for you. Chris Marangi of Gabelli, former New York Fed President Bill Dudley, Becky Frankiewicz of Manpower, and Bloomberg's Ed Ludlow. Your equity market on the S&P 500 going towards the opening bell, 94 minutes away. Equity futures positive, 0.33% from New York. This is Bloomberg.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of finance, right to the point where he's being pushed, but he pulls back because similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The Fed really doesn't have much of a case right now to cut rates.
If you're the Federal Reserve, why would you even think about cutting interest rates when the economy continues to be really solid?
To me, this is a Fed that cares less about getting to 2 and more about preserving and extending the expansion.
One direction or another, they can just sit tight for a while.
The idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Big week for jobs data kicks off in a big way in the next 24 hours. We're going to get jobless claims in just a moment, 30 minutes away, then on to tomorrow morning, looking for payrolls. Payrolls, the estimate, just in and around 200K. A very punchy call coming from Citi's Andrew Honhorst. They're looking for 150 on Friday. They're looking for continued weakness. And take a listen to this, their rate cut call for 2024. Not the next 2 years, the next 9. They're looking for cuts of 125 basis points, Lisa. That is double what this market is priced for.
At one point, that would have been viewed as a really bullish call because that would mean that basically everything would get turbocharged. His point has been consistently, this is on the heels of weakness, and the labor market's going to really be on the leading edge of that, and it's going to turn quickly.
Looking for numbers later this morning at 214 for jobless claims. That doesn't look like weakness to me. The previous number, 210. Tomorrow, the estimate, the median estimate in our survey, Anne-Marie, 213,000, down from 275 the previous month.
Yeah, and unemployment rates expected to come in at 3.8%. If you have a 2-handle, Jonathan, which you've said a lot of times on this program, a 2-handle non-farm payrolls, where can there be weakness? And then to your point, and to Terry's point, the mirage, just this 6 months, just keeps being pushed out for the year. Potentially we could see that rate cut, which why I thought Bostic was almost more interesting than Powell yesterday, who was similarly dovish as usual, Powell. But Bostic said, I actually see the rate cut down the line this year, and it's only going to be one.
Mohamed El-Erian joined us on Fed Decision Day, and the question he asked at the time, the right one, how committed are they to that 2% inflation target? Has it now become a range of, say, 2 to 3? And if it is a 6-month rolling effort, the objective is just continually 6 months out, we will get there eventually. Does the market start to pick up on that? And I would argue maybe, just a suggestion, a hint in precious metals over the last few weeks, that the market might be.
And that's also what you're seeing when it comes to real yields. That said, it does seem like, in general, you haven't seen inflation expectations pick up to the same degree you might expect. I'm thinking of the University of Michigan sentiment survey that call 500 people, and people say that it's not necessarily picking up all that much. I mean, is this something that we're going to rely on? Because you're not seeing people, wholesale freaking out in the bond market or in some of the futures markets about the potential inflation. That's what I'm watching, though. Why not? Because right now it seems like this market believes the Fed can bring it back down to 2%.
I think it does reveal an inherent bias from some commentators when they'll point to certain data points when inflation was too high to say that it wasn't a problem, and now when it's on its way back down, they'll point to those same data points in a different way. So at one point they're viable, and at another point they're not. Sometimes they're flawed, sometimes they're useful. The Federal Reserve's danced around that issue a million times as well. I remember when people said JOLTS wasn't an important indicator. Do you remember that?
I remember that very clearly.
And then JOLTS starts to move in the direction that's in favor for the Federal Reserve to cut interest rates, and guess what? Really important indicator. It shows we're sufficiently restrictive. Quits rates down.
I'll put another one throw another wrench into the fire here. The idea that the data that we might get might be revised completely in a different direction in 6 months or a year's time. So this goes to this flawed concept of data dependency that we talked about a lot yesterday. How much can we be dependent on data that is inherently flawed and insufficient with, sort of low survey response levels, et cetera, et cetera? This is the compass that people have to look at the world with. That's the reason why it's the collection of data, and that's why our heads are spinning, because you can read it any way you'd like.
How dependable is that data? Equities right now on the S&P 500 positive by a third of 1%. Yields picking up in the last couple of days. We are very close to 440 on a 10-year. Got there yesterday, backed away. 436.93, higher by 2 basis points this morning. The euro firmer by about a tenth or two of 1%, 108.53 on euro dollar, and crude 85.40. Coming up this hour, Chris Morangi of Gabelli Funds on his call for a soft landing, former New York Fed President Bill Dudley on why he thinks the Fed is wrong about how low rates will go, and Manpower's Becky Frankiewicz looking ahead to March payrolls tomorrow morning. We begin with our top story. Stocks mixed ahead of payrolls Friday. Fed Chair Jay Powell saying the recent data hasn't materially changed the overall picture. Chris Morangi of Gabelli Funds saying this: we see reduced odds of both recession and rate cuts converging towards a Goldilocks backdrop. Markets are strong, with Q1 returns driven by multiple expansion. Growth in large cap again outperformed value in small cap, but there was some rotation in March, which should continue in a soft landing. Chris is with us around the table. So Chris, let's start there. Good morning.
Good morning.
Why can this rotation continue?
Well, again, if you believe that we're in for a soft landing, and it sure doesn't feel like Goldilocks, but the data seems to indicate that maybe it is, then the smaller cap stocks, the more cyclically sensitive stocks, are going to do relatively better. People will stop hiding out in the mega cap tech, expecting higher rates.
So is that energy, is that banks, the things that did well in March are going to be the winners in the next quarter too?
Yeah, I'm not sure about banks. Banks are a little bit idiosyncratic because you're worried about some credit issues, particularly in commercial real estate, obviously. But yeah, in small cap industrials, which did well at the very end of last year, we'd expect it to continue to do well through the rest of the year.
Chris, one of your sort of ways of thinking about the world is to select a small number of stocks and invest in them and do a lot of ground-up research on each one of them. We talk a lot of the macro picture. How much of the macro picture has caused you to shift some of what you're holding currently?
Well, I'd even step back. I mean, we're not just picking stocks individually, we're picking industries where over long periods of time, companies can create for themselves sustainable competitive advantage, irrespective of the economic backdrop. Obviously, the economy is an input into our models we're thinking about as we think about earnings and we think about multiples. So we do pivot on occasion. I think we're feeling, despite what I said about soft landing, in general, we tend to be a little defensive. We tend to like less cyclical recurring revenue names. We like some of the rate-sensitive names today, some like utilities, even Staples, which had a tough day yesterday. So we think about all those things as we come up with our private market value, but ultimately we're looking for stocks that are cheap.
It's interesting to me that you're picking stocks that are more rate sensitive at a time when that's one of the big disagreements. We've been talking this morning about at what point do bond yields really pose a problem to stocks. Do you think that there is a resiliency baked in just simply because of the growth picture that's allowed yields to climb?
Well, yeah, obviously a lot of those stocks got killed over the last year, and don't think rates are going up. So, there's a chance for resumption of earnings growth and continued multiple expansion, again, which we saw in the first quarter with some of those names.
Can we do some single names then? Can you tell us in tech what you'd leave behind, what you'd drop? What have you sold?
Yeah, I mean, listen, we were a little late onto Meta, still like that one.
With
it. As well as Google. I'm a little bit worried about Google. I see some parallels between what we saw in media and Google. Google's no doubt a leader in AI, but is the search business of the future as good as the search business of the last 10 or 20 years? In other words, can they replicate the monopoly that they had in search in a world of AI? And I'm not sure that they can do that to the extent that they once did.
When you say there are similar problems in media, is that what you mean by that, the challenge that AI presents, or something else?
It's the whole analog dollars for digital dimes type trade-off. And obviously, AI is more expensive, unclear how they monetize it, although there are increasing signs that they can monetize it either through subscription, as we saw yesterday, working with distributors like Apple, et cetera. But is that world going to be as good as it once was for Google? Now, Google, of course, does not trade at a particularly steep valuation. It actually trades at a discount to the market. So much of that has already been priced in, was priced in last year.
But you're staying with that name for now?
We're staying with that name for now.
Okay, I want to introduce Disney into the conversation as well. You mentioned media. Big win for Bob Iger just yesterday. What is he doing right? What is he doing wrong?
Yeah, Trump-Biden, this was not. I think this was a foregone conclusion. There's no doubt that Iger's got the magic touch, and he's done a great job with Disney. But Disney does have its issues, including finding a successor to Bob Iger, which was certainly highlighted in the Trian proposal. Still something that they need to deal with. Listen, Disney has an unrivaled stable of brands, and they've got the parks business, which is doing great, continue to do great. I don't know what they do with ESPN. That's a big question mark. And the stock has obviously had a huge run, a sneaky huge run in the backdrop of this Trian fight, and it's not cheap here.
Well, let's talk about some of Trian's proposals and what might still get effectuated, because it did garner as much support as it did among investors. The idea of running more like Netflix, the idea of distributing more of the potential cash flow to shareholders, and spinning off ESPN or doing something. What of those do you think is most likely to go through?
Well, I think all of those are under consideration, obviously, at all times. Among the other things that I think has been focused on is continue to focus on the parks and reinvest in the parks, which is a very good business, which Comcast, which owns, of course, the Universal Parks, has done to a very great extent. I think that's going to happen. As far as I think there has been a reinvigoration of the content investment, looking for more originals. That, of course, was impacted by the pandemic as well as the strike. Put a little bit of an air pocket in that. But so we'll see what happens over the next few years with the slate. You're not going to see that overnight, for sure.
Chris, can we talk about the importance of leadership? I struggle with this. There's 8 billion people on the planet, and we're sort of led to believe in media circles and on Wall Street as well, that there is only this one person that can run this company, and his name is Bob Iger, and that's why there's this massive struggle for succession. How important is one person, one man? Are we serious that out of 8 billion people on the planet, we can only find one guy to run the Walt Disney Company? Are we meant to believe that?
Yeah, some people would have you believe that. I don't necessarily believe that. I do think that leadership and those leadership qualities are scarce, but there's not one person. We tend to like businesses like Buffett that can be run by any idiot, a ham sandwich, which again, Bob is clearly not. But listen, he has a charisma, he has a certain drive, he has a certain likability within the company to get everybody moving in the same direction and to, again, restore the creative magic that has been lacking over the last few years.
Are you still a shareholder? Are you still a shareholder of Disney?
Small. We haven't been in the stock in a long time.
The reason I ask these questions, I think it is an important conversation to have. I think that when you have CEOs of public companies that have been there a long time, they start to behave like founders. They're not founders. They're meant to be custodians of public companies. And if they haven't come up with a succession plan, why aren't we having more serious debates about the failure of coming up with a succession plan? If we're all led to believe there is only one guy that can run the Walt Disney Company, shouldn't the conclusion actually be that he has failed to find one person out of 8 billion who can run this company? And isn't that part of his job as the CEO, as the custodian of a public company? He's not a founder. I see this in industry after industry, that we treat people who lead companies for a long time as if they are the founder of that company. They're not.
I think you're right, and I think that criticism by a number of the activists, not just Trian, was spot on. That is the major failure of this board, and frankly of Bob Iger, is to find somebody to replace him.
I mean, I think it's an important point, and I think that this kind of goes to the moment that we're in also, because it's in politics and it's in business, and it sort of points to this issue that anyone new is going to be controversial because they have to put a new spin on a company that's established itself in a far less controversial moment.
So Nelson Peltz's point, I think, is a valid one, and I wonder which other companies out there need the same treatment. Can you think of some right now?
Well, we certainly have plenty of founder-led companies in media and technology, obviously, and coming to.
Well, founders, excluding founders from this conversation, they gave birth to these companies. I'm talking about people who are in these seats that are acting like founders when they're not.
Yeah.
That's the issue that I've got.
I won't name names, but I will say that, Lisa said, what changes can we expect? I think you're going to see a lot more activity on the succession front at Disney soon. At least, we've got a stable of individuals who are being talked about. I don't know what kind of process they're going to run, but you're going to hear a lot more about those individuals over the next year.
Fascinating. Forgive the rant. I'm not that passionate about it. Chris, thank you. Chris Morangi of Gabelli Funds on the latest in media and elsewhere. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hakes. Hey, Yahara.
Hi, John. Boeing's crisis has left major airlines desperate for planes, sending the cost of used jet rentals to the highest level in years. As Boeing slows production following January's Alaska Airlines door blowout, competitor Airbus is struggling to lift output, leaving airlines searching for the largest single-aisle jets they can find. Monthly rents for those jets now topping out around $335,000. Lessors are gaining leverage and likely to shift planes to airlines willing to pay a premium. Disney shareholders shot down activist investor Nelson Peltz's effort to win seats on the company's board. Investors voted to re-elect all 12 of the company-backed board members, including CEO Bob Iger, ending the most expensive corporate proxy fight in history. Peltz Triumph Fund Management holds a more than $3.5 billion stake in Disney. It has been trying to get seats on the board to address lagging shareholder returns and what it sees as inadequate corporate governance. Tesla CEO Elon Musk says he's boosting pay for AI engineers as the company deals with a talent war. Musk posting on X that OpenAI has been, quote, aggressively recruiting Tesla engineers with massive compensation offers and have unfortunately been successful in a few cases. Musk going on to say the talent war for AI engineers is the, quote, craziest he's ever seen. The tech billionaire is pursuing AI projects through Tesla and his XAI startup. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, it's the markets versus the Fed.
Given the strength of the economy and progress on inflation so far, we have time to let the incoming data guide our decisions on policy.
That conversation up next, live from New York. Good morning.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Live from New York City, equities positive 1/3% on the S&P. Under surveillance this morning, it's the markets versus the Fed.
Given the strength of the economy and progress on inflation so far, we have time to let the incoming data guide our decisions on policy. If the economy evolves broadly as we expect, most FOMC participants see it as likely to be appropriate to begin lowering the policy rate at some point this year.
Here's the latest this morning. Fed Chair Jay Powell saying that recent inflation data hasn't materially changed the overall picture when it comes to rate cuts this year. Former New York Fed President Bill Dudley saying he thinks the Fed is wrong about how low rates will go, writing this: betting against the Fed is a fraught endeavor. Nevertheless, in this case, I think the market is right. While the Fed's projections for 2024 look likely to be more accurate than the markets at the start of the year, this time around, it's the central bank, not the market, that will probably have to adjust. Bill, I'm pleased to say, is with us now for more. Bill, this came up in our last conversation together, the spread between the market and the Federal Reserve. What do you think explains that? Is that just a refusal, a reluctance of this Fed to really engage in that debate before we get past this inflation, this inflation hurdle?
Probably the Fed is focused more on what they're going to do in 2024 and don't have a lot of confidence about what's going to happen beyond that. What I think is interesting is earlier in the year we had a gap between the market thinking the Fed was going to ease quite a bit, 6 rate cuts. Fed only had 3. That's closed, but now the gap has gone the other way. The market thinks that the federal funds rate is going to bottom out around 3.75%. The Fed, in their summary of economic projections, has it going down to 2.6%. So there's over 100 basis point different. I think the market's right that the Fed's not going to go as far as the Fed is projecting in their summary of economic projections for 2 reasons. One, inflation is probably not going to average 2%. It's probably going to average a bit higher than 2%. And number 2, R-star, the so-called neutral rate, that sets a neutral monetary policy, probably has risen, given the large fiscal deficits, the AI investment spending boom, and a host of other factors that are basically putting more pressure on the pool of savings.
Bill, I often reflect on a conversation you and I had together a number of years ago. I'll sing your praises because you're a modest man and won't do it for yourself. You said in June of, I think, 21 that rates are going to go much higher than people think. And I remember when you talked about 5, and 5 sounded so foreign. 5 at that time now would be like me saying that 10-year yields are going to 8%. People just turned around and were like, Bill, you're nuts. We're not going to 5%. What did you see that early that led you to believe that rates would need to be that high to get inflation down? And how does that inform your view of where things will be longer term?
Well, the Federal Reserve set themselves up deliberately to be late in terms of tightening this last cycle. They basically said we can't raise rates until inflation is 2%. We're at full employment, and we expect inflation to be 2% above 2% in the future. So by definition, they were going to be very late. If you're late, that means you have to do more. So that's the reason why I thought that the rates would have to go quite a bit higher than they expected. This time, I think my disagreement with the Fed is the fact that they still think neutral federal funds rates very, very low. 2.6% is their median estimate of the long-run neutral federal funds rate at 2% inflation. And I think that's probably not the case. I mean, it's true after the great financial crisis when we had a lot of financial damage to the economy. But if you look back at the Taylor Rule prior to the great financial crisis, Taylor Rule had 2% real rates as neutral. So the 0.6% reading that the Fed has as their median estimate seems awfully low to me.
Given that, how much do you think that there needs to be a full repricing of just how much of a cutting cycle there needs to be in the very near term? In other words, if 3 rate cuts this year seems a little bit lofty, given how strong the data has been, and you see a more likely chance of 2 or 1?
Well, I think this year is really going to depend, as Powell says repeatedly, on the data. Small differences in the growth rate and the inflation outlook are going to change whether the Fed does a little or more. I don't think 3 rate cuts are out of the realm of possibility. I think where I disagree is more longer term. And you've seen what's happened. The market's repriced that longer term upwards. 3.75% is the bottom for the federal funds rate. And that's what's pushing up 10-year bond yields. So the bond market is adjusting to the fact that they're changing their expectations of where the Fed's going over the longer term.
The reason why I ask this is because every time we hear from Powell, he talks about bumps in the road. And he talks about how recent data, even though it's come in hotter than expected for the most part, doesn't alter his view that it would be appropriate to start cutting rates at some point in the near future. At what point should that shift? Should some of these data points be viewed as something other than bumps?
Well, his view is that monetary policy is tight, and so it's just a question of time before it slows the economy. The other thing he thinks pretty strongly, and he's talked about this yesterday again, is that the reason why growth is strong is because of supply chains normalizing. So you've supply constraints for holding back the economy, supply chains normalizing, you get a one-time increase in the growth rate. I think that what he's underestimating is the fact that financial conditions have eased a lot since late October, and that's also supplying considerable support to the economy.
And it also raises this question, I know you addressed this last time you were on, about whether policy is truly restrictive or not. And you didn't think it was nearly as restrictive as many people had expected. Do you think that there are more people on the Fed who are coming around to this view, who are thinking, wait a second, if we're seeing such easing in financial conditions at rates where they are, maybe that suggests we're not nearly as restrictive as we keep saying?
I think very slowly we're starting to see that happen. The median estimate from the Fed officials about where neutral federal funds rate is at 2% inflation moved from 2.5 to 2.6%. So it moved a 1/10%. So it's starting to move. And the other thing that's important here to note is there's a big skew to Federal Reserve officials' estimates. The bottom is at 2.4, the top is at 3.8. So there's plenty of room for the median to move considerably higher than the 2.6% that they have today. So I think it's going to continue to drift up.
Bill, love this piece. Fantastic. Just out this morning, Bill Dudley of Bloomberg Opinion. Bill, thank you. The title of this, please, the headline. The Fed is wrong about how low rates will go. Betting against the Fed is a fraught endeavor. But Bill says, in this case, I think the market is right.
Basically looking at a terminal rate of 3.75% as being where the destination is. If you take it a step further, how does that transpire in markets that have already come around to that? Have risk assets truly priced that in? Is that something that's priceable when we don't understand the financial conditions around it in terms of what the economy looks like? This is one of the reasons why my head is spinning. Do we understand just what the consequences will be on risk assets? When I remember when the rate hiking cycle began, people were saying expect really low returns for the foreseeable future because we're going to bring back all of those years of great returns from easy money policies. This is the part of this that just isn't adding up.
I mean, never mind the last few years. Just look at the last 5 months. The last 2 months of 2023, and we had rates grinding lower. In many ways, Treasuries absolutely ripping, yields down, expecting rate cuts. Equities did great. You start 2024, and you're thinking we need more of the same. You need to start pricing in rate cuts. Fed needs to lean into a cut in March. Did completely the opposite. Equities just took off. 10% gains in Q1. And it's that relationship, your head's spinning, mine too, trying to interpret this relationship between what is happening in fixed income and commodities now and working out what it means for stocks.
Andrew Hollenhar is talking about the potential for double the number of rate cuts on weakness to the S&C. Going back to what you just said about late last year, those rate cuts were considered a positive for stocks. Now, my hunch is those rate cuts would be not viewed as positively if they came on the heels of such weakness, which just highlights how turned around some of the narratives have been over the past 6 months.
On its head in just 5-6 months. Up next on the program, more economic data. Mike McKee's going to break down jobless claims for you. They drop in about 5 minutes' time, and we're going to catch up with Becky Frankiewicz of Manpower, here to react to what's happening in the labour market. Jobs day just around the corner, payrolls 24 hours, 4 minutes, and 13 seconds away. Something like 200K is the estimate from New York. This is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Right? I mean, are we looking for some sort of sudden shift that Andrew Hollenhorst is reflecting in his note? Or is this just sort of the slow grind that we're going to see initial jobless claims potentially slowly rise over time?
Well, history tells you that we do see, when you go into a recession, you can go into it very quickly. The data can change very quickly. But we have so much data now, it's hard to think that we would see a real huge shock in the employment numbers, and we haven't had one for a very long time. I mean, you can have them when you have bad weather, something like that, but at this point, the surprise would be not that we see a terrible number, but that we see a number that's way off from what economists anticipate. Wall Street thinking we're going to see a strong number tomorrow. They're at 227 on the whisper number, where the forecast is 213.
So we always talk about this, and I think it's important, especially heading into tomorrow, which data matters most. And you pointed to, when we got the ADP report, that 10% figure in terms of wage gains that job switchers got. How important important was that, given that people kind of question the relevancy of this particular set of data?
Well, people are going to, the Fed is going to be taking a look at it, and they'll be looking at average hourly earnings. They prefer the ECI for a more accurate look at where wages and salaries are going, but we have seen average hourly earnings still over 4%. Great for the consumer, but the Fed thinks 3.5 is the top end of where you are seeing sustainable levels. So they'll be watching that, but it's the headline number and the unemployment rate that are going to get the most attention on Wall Street and at the Fed, because Powell basically has laid that out in his last two speeches, that we won't feel a need to cut unless the labor market weakens significantly, because the rest of the economy seems to be doing fine.
Mike McKee, thank you, sir. 221 is the number. Jobless claims, the wrong kind of upside surprise. 221, the estimate 214. Setting things up for payrolls tomorrow morning. The estimate, if you are just joining us, in our survey, the median estimate is 213,000. The previous number is 275. Quick snapshot of the markets for you. Equity futures still positive by 0.4%. It's a lift for the equity market, up by 0.5% on the Nasdaq. Yield still elevated, interestingly. If we switch up the board and get to the bond market, the 10-year still higher by about 2 basis points, Lisa. Personally, I was looking for that to back away off the back of that claims number. Didn't happen.
The fact that you don't get much of a reaction in markets tells you that people are kind of discounting this as noise, at least for now, and that there have been so many data points that just, a miss by a couple thousand here or there isn't going to change the dial.
Joining us now to discuss the labor market is Becky Frankowitz, the Chief Commercial Officer and North America President at Manpower Group. Becky, wonderful to catch up with you. One thing we love to do with you is talk about what's happening with temp workers, the shift between temp workers and permanent hires. Can you talk us through how that's evolved as the year has progressed?
Yes, so normally coming out of a recovery or into a recovery out of a recession, you would see employers want the flexibility of temp workers. So that's a measure called temp penetration. We would see that increase. We have seen that below 2%, which 2% is the average, consistently, and we're starting to see even further declines in temp penetration. However, the offset of that is we're seeing permanent hiring continue to be strong, which definitely reinforces two things. One, employers are still hiring, and two, there's a bit of post-pandemic hangover where employers couldn't find the talent that they want, and so they're scared not to grab them and make them permanent employees. And so that will be a number I'm watching tomorrow, what's happening in temp penetration, but perm will definitely be strong.
Becky, did that make it difficult to read into where we are in the cycle? Are those traditional indicators broken because of this approach post-pandemic?
Yes, I would say the human behavior has now come into the algorithms that everyone is using, and it's very difficult to predict where we are in a cycle given that. However, again, the resilience of this labor market, John, is just amazing. We continue to see strong numbers. If we see a 213 or a 250 tomorrow, I wouldn't be surprised anywhere in between, which definitely demonstrates a very resilient labor market.
It also highlights the sort of rolling recovery and rolling recessions within the labor market, as well as in the broader economy. Where are you expecting the jobs to be added? For a while, it was more focused in the services sectors and the sort of people-facing areas that had gotten hardest hit during the pandemic. Are we seeing that shift to some of the areas that have been left behind of late, in particular middle managers and other types of professionals?
Yeah, so BLS, the jobs numbers, look in the rearview mirror. We're looking at real-time data every day in terms of demand for jobs in the country. And we're seeing increased demand in affordable experiences, I like to call it that. Think hospitality and leisure is where it shows up. But the biggest hires in the country today, the biggest employers looking for labor are Walgreens, Family Dollar, Great Clips, the hair clip franchise, so consumers seeking affordable experiences and companies then needing to hire. So that's one. Another is tech continues to be strong. Software developers are the #2 job, most in demand in the country. And AI machine learning, which you spoke about a bit earlier on the show, continues to set records week over week, month over month in terms of demand. So big demand for AI machine learning engineers specifically.
Becky, is there anything that you're seeing on the ground that coheres with this idea of a sudden fall off in demand for workers that could happen within the next 6 months?
Yeah, I don't think we're going to see a sudden fall off. If anything, I think the word of the year is stabilization. We're seeing a bit of rebalancing from the post-pandemic highs and lows. Employers are taking a more measured approach in terms of who they're hiring, again, tending towards perm, and employees are staying put. I mean, we're seeing the quit rate really level off. And as you alluded to in the jobless claims today, we're not seeing layoffs spike either. And so people are staying put. Companies are holding on to their workers. for the most part, and we're starting to see some evenness in terms of demand, some stabilization, I would call it. I don't anticipate a drop off. If anything, the PMI going above 50, I'm hoping to see some expansion, particularly in skilled trades in manufacturing.
I want to lean into that AI competition that you're seeing in the labor market, because Elon Musk, as we said earlier, called it the craziest he's ever seen. How difficult actually is to attract that talent that can fill this industry that's fueling the stock market?
Well, I think first the question is the talent available? So attracting the talent is incredibly difficult because we don't have enough AI machine learning engineers. The population of skill isn't large enough. So we have to upskill and reskill people into those jobs. But it is a very, very hot market. And let's just take a minute to define what in the world is an AI machine learning engineer. They're the people that write the algorithms. They do the user interface so that we as users can log in and chat GPT, and it's a usable platform. So that's the kind of skill we're looking for. A lot of data analytics, programming experience. That's what you need to have adjacent skills to upskill into the AI machine learning engineers.
Becky, not to weigh into the political sphere, but I am curious what you make of what Jerome Powell said yesterday about immigration and how much that has contributed to a robust labor market without sort of commensurate inflation. How much are you seeing that within your world in terms of new immigrants, legal or not, taking up jobs that then really keep wages more reasonable, I guess, for the employers, and potentially not rising as much for the workers?
Yeah, I thought it was a very provocative point of view. I'm not sure we're not seeing that. We only hire people who, are legally able to work in the country. But we do believe in immigration because we see that the structural economy has changed. We don't have enough workers. And so we don't have enough skilled workers, but we don't have enough workers. And so that would be our point of view, is we would support, anybody who can work. We want to have them access to work. But in terms of what is that got, hiding in the numbers, I think it goes back to the old algorithms aren't holding in this recovery. And it's one of the reasons that I would push on the Fed when we say they're waiting for the labor market to decline in order to cut rates. The old algorithms aren't holding. And I think we probably should explore that a bit.
Hey, Becky, wonderful to explore it with you. Thank you. Becky Frankowitz there of Manpower Group on a situation in the economy. Difficult to get a read through traditional indicators of strength or weakness when things seem a little bit broken post-pandemic.
It's kind of a theme. We heard that yesterday from Edward Morse as well, basically saying that the indicators within the oil market are broken, the indicators within the labor market are broken, the indicators with inflation are broken. So this raises this issue, right? What's your lodestar at a time where a lot of the traditional indicators and algorithms are flawed?
Mine is the S&P 500, session highs up 0.5%.
I'll remind you of that.
Equities marching higher. I'm sure you will. It's not really, just for the record. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief. Hira Hackers. Hey, Hira.
Hi, John. More tech layoffs, this time at Amazon's cloud division. Amazon Web Services is cutting hundreds of jobs that will affect sales and marketing employees, plus the team developing the technology used at physical stores. It comes after sales growth at AWS slowed to a record low last year as corporate customers cut back on spending. The pass rate for the first level of the CFA exam jumped in February to 44%. That's higher than the historic average and above the pass rate back in November and August of last year. Those who took the test for the first time scored significantly above the average pass rate at 52%, while those who deferred their exam had an average passing rate of just 28%. Chinese EV maker BYD is planning to launch its first electrified pickup truck later this year, and it plans to take it global. BYD already dominates China's EV market, but the company has been pushing into Asia, Australia, and South America, where pickups are popular. BYD vehicles are not available in the U.S. That's your Bloomberg Brief. John?
Yeah, Ira, thank you. I find the timing of that launch to be quite interesting. Janet Yellen landing in China, BYD launching a truck. We're all sitting here waiting for the next tariff move from the administration. Just how far away is that move?
Yeah, and really, is Australia the main demand for pickup trucks? No, it's the United States. I mean, it always has been. It's
Without
the place
a doubt.
that trucks actually are sold. So yes, to your point.
But they're going to have to infiltrate the market they can get access to. Even without fresh tariffs or some sort of provisions on EV imports from China, it's more than 25% tariff currently to import an EV from China.
We'll explore that conversation in just a moment. Up next on the program, Apple's search for its next big thing.
As a project,
The car initiative was just a drop in the ocean in terms of cost. Apple has not lost their module. You know, they either do things perfect or they don't do them.
That conversation coming up shortly. Your equity market in this session highs up 0.5%. Just moments ago, jobless claims in America delivering a little bit of an upside surprise. The wrong kind, 221. The estimate was 214. Your payrolls report tomorrow morning, looking for a number in and around 200K. From New York City, this is Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Equities on the S&P positive by 0.5%. Just had jobless claims moments ago, 221. The estimate 214. Next stop, we get payrolls. The estimate 213. The previous number 275. Yields do start to fade now, Lisa, as anticipated, just on delay by about 15 minutes. 435 on a 10-year.
Well, this market, I mean, I've got to forgive the market for a delay, because right now it's not clear what a couple extra thousand jobless claims are going to do to the overall picture. But on the margins, it confirms what we saw yesterday, which is on the margins, just a little bit more softness that we saw in services.
That's been a theme of this program so far.
Well,
on the margin,
more
kinda. On the margin, sort of.
Do you have anything better?
No. I went with kinda. You went with on the margin. Kinda stronger euro right now. Euro dollar 108.62. Dollar just a little bit weaker. That currency pair moving out by about 0.25%. Under surveillance this morning, Apple surge for its next big thing.
The positive news here is Apple has not lost their module. You know, they either do things perfect or they don't do them. As a project, the car initiative was just a drop in the ocean in terms of cost. We're still facing a situation where Apple is not a high-growth business, and valuation is a bit of a challenge in these circumstances.
Here's the latest this morning. Apple reportedly looking to push into robotics after its efforts to develop an electric car fizzled out. Sources saying engineers are working on a personal robot that would follow customers around their homes. Apple is looking for sources of revenue and ways to capitalize on AI as the tech giant comes off its worst quarterly stock performance in more than a decade. Bloomberg's Ed Ludlow joins us now for more. Ed, so it's your challenge to explain this to the three of us. What is this robot going to do?
To keep a straight face and explain it to you.
It's going to follow you around your home?
Yeah, the big picture idea is that born out of the car project, Project Titan, which has been scrapped, Apple's thinking about over the next decade, 2 decades, 3 decades, where do they find penetration? And they think that it's in your home, right? They've got us on the handset, on the iPhone. In the car, it looks like that project's done, but they get us with Apple CarPlay. where do we spend the rest of our time? Some of us make it home and we spend it in our homes. And it's an area Amazon's pushed into, right? A lot of devices that are in the house. What we're talking about is literally a small form factor robot, according to Mark Gurman's reporting, that, yeah, follows you around, has a screen interface. There's also, by the way, a second, more simple version where you have a screen on, say, your kitchen counter, and I'm guessing it's wheels-based, but it also follows you around and has mobility.
How does this go with the headset, the virtual reality headset? How do those two things reconcile with each other?
I actually don't know the answer to that. What is the link between a robot and the headset? But what they have in common is the technology is also born out of the car project. You know, the origin of Vision Pro was that they were thinking about the use case of virtual reality in the car. Because remember, the original plan for the car was it was completely self-driving. A premium product where you'd sit in the back and not have to do anything other than enjoy your own time or work. And the technology underpinning this robot, according to Mark's reporting, is very much the same.
Are we that lazy that we want relationships without having to put the work into it? It's like, you know, previously people bought a dog. People previously had relationships or kids. Now you can just have a robot that follows you around, and it sounds great.
I get the laziness part. I think that this story, along with the Google story that's out this morning, is just evidence that the big companies haven't really worked out yet, A, what the everyday human is going to use AI for, you know, in their daily life, and how they're going to make money from it as a consequence. You know, the chatbot is very low-hanging fruit. But, I mean, come on, I grew up in the 90s, early 2000s. I love sci-fi. I can envisage that.
Do you want that? Would that make you feel warm and fuzzy?
But I'm not prepared to pay $3,500 for it at the moment. That's the thing. We're talking about Vision Pro in particular. We don't know what the price point of this robot is. And as Mark points out in his story, it's very early days. But say they put a $4,000 price point on it, then I think most people around the United States and elsewhere would have the reaction that the three of you have had, which is to put a wry smile on the headline of the story.
But, and sorry if you already said this, what is it doing? Following you around and doing what? Is it a Roomba? Is it vacuuming?
So there are similar products out there already, one of which is from Amazon. Think of it as a screen on wheels. You have a visual interface.
But I have a phone that I carry around with me to do that.
It's going to walk.
But then you've got to hold it in your hand, Anne-Marie. And in this case, you know, I know it's strange.
How lazy how we've become.
I don't know if you saw the market reaction, because there was some. So Apple had a kind of little disappointed, muted pair of games. But iRobot actually jumped, absolutely soared. And the logic that the street's putting on it is, if Apple's doing this, there must be a market for robots that do trivial or meaningless things around the house.
How early stage is this?
Very
Is
early
this just
stage.
a reaction to dropping the EV and move into something new?
It's not a reaction to dropping the EV. They started thinking about it in 2019.
Okay.
But all of these projects are multi-year projects, and we're far away. Your skepticism is fair in the sense that I don't think that this is something that Apple's going to unveil in the next calendar year. It's something that they're testing the waters with.
Yeah, don't rely on me to predict the future of technology.
I
You know,
would.
I'm absolutely terrible at this. I'm just trying to work out what the problem is they're trying to solve. And typically when you go into anything like this, usually you're trying to solve a problem. What is the problem they're trying to solve?
Yeah, I think that it's a hardware solution to the same thing that a chatbot offers us as a companion. You can pose questions to it. I'm an Alexa household, for example. I use Alexa in every room of the house for things like requesting music, but I also add to a shopping list. Other voice assistant tools are available.
John asked, what void is it filling? What role is it seeking to fill? And is it really kind of self-reflective? It is trying to fill the void of more than half of their revenues coming from the iPhone
story. Yeah.
and being really vulnerable to that. Does this sort of indicate how vulnerable they are to the lack of diversity with their profits?
It's Apple experimenting, and to answer all of your questions, not knowing how we as humans interact with technology in the future. It's normal to use a voice assistant now. My fridge is Wi-Fi connected. I can ask my fridge to remind me to buy milk. And why would a robot following around make that more easy? I don't know.
We live very different
lives. That is what we're talking about.
Is that what you get from your fridge?
A plant-based milk. I live in California, but yes.
Does it order it directly for you as well?
Yes.
It does.
Come on, guys.
It's such
it's
a West Coast thing,
2024.
isn't it? I know.
One of our viewers just wrote in, based on my experience with my wife and kids, it is very likely that I couldn't get a robot to listen to me either. And I have to say, I can imagine that. Come on, I said over there.
Can we pick out a single name just quickly? I just want to shift gears because I know we've only got a few more minutes left. I'd love to talk about this much longer. Can we look at Ford?
Yeah.
Ford is up in a pre-market by something like 1%. Some changes to the lineup, Ed, expected to develop in the next year or so. They're just pushing out plans again to bring some of these EVs to market.
Three-row SUV and expensive EV products it will have a union impact because it was a plan that they already had. But actually, I don't want to criticize our colleagues. There is no headline on this on the terminal. There should be. Read the press release and look at the hybrid portion. They are accelerating their hybrid plans and expanding them. And this is the story I've been on set talking with you guys about for quite a long time
It's where
now.
demand is.
Yeah.
It's where the market is.
For all of the reasons, range anxiety, the reality of the economics, and the investors cheer it. One thing real quick, if you speak to the CEOs, they would admit to you that their biggest problem is there aren't enough EV models available. The irony being that they can't do anything about it. They still have to push back the plans. That's a big challenge right now.
What do you think of the BYD truck coming to market? What was your reaction?
Well, there are pickup trucks in other markets. Interesting timing. You know, BYD offers commercial vehicles in this country, buses, stuff like that, no consumer cars. I think, is the Treasury Secretary in China?
Yeah. Just touched down.
Yeah, kind of interesting. You know, BYD is pretty noisy at the moment, and they have a hybrid strategy as well, but I'm sure they have their eyes on other markets outside China.
In all your coverage, when you talk to all the founders and the executives of all these tech companies, do they want to see that relationship with China preserved from the U.S. and the sort of cross-pollination that a lot of people are targeting in the White House and in Washington?
Well, their actions would suggest so, because they all make the pilgrimage to China when they can. And in November, when President Xi was in San Francisco, that was the story. Who was at the dinner table? It was the tech company CEOs. But they have two problems: supply chain and customer base. You know, if you're an electronics company or a car company or a cloud company, you know, China is your customer, but it's also where you're getting all your compute components from as well. It's very difficult to manage.
Thanks for trying this, Ed, just to explain what's happening with Apple. Appreciate it. Ed Ludlow there.
Thank you.
Coming up on Bloomberg Technology in a few hours' time alongside Caroline Hyde. Look out for that. Coming up tomorrow morning, this is what we'll be talking about. Payrolls Friday. Fantastic lineup for you as always. Sarah House of Wells Fargo, Priya Misra of JP Morgan, former Fed Governor Randy Gersner, and Mohammed Al-Erin of Queen's College, Cambridge. That conversation is going to dominate things, Lisa, tomorrow morning.
I'm still just thinking about the robot. I'm just thinking about whether it actually fills a role or whether it's just companionship at a time where it seems like, you know, people are trying
Still on the robot?
I can't get past it. I'm thinking, does it get in your way? Do you end up kicking it by accident? Does it end up talking to you? Does it remind you of things repeatedly when you don't do them? I mean, is it naggy?
Well, this is the
Sounds
issue.
like a spouse. Is that what you're describing?
No, I'm not saying.
personal?
No, I think one of her kids asking.
Where that was coming.
I'm just saying, you know, is it, you know, something it's a bother, or how does it become a joy?
I think to John's point, they haven't figured out the use case, because what problem is it solving? And until we know that, we don't really know what this robot's going to do. Also, everyone's concerned on Alexa listening to you, potentials for national security. You want to put a robot in your home, listening to all your conversations, following you around? It's kind of weird.
I was trying really hard to talk about payrolls, so let's go solo. Equities right now on the S&P 500, positive 0.6%.
What is there to say?
Jobless claims, an upside surprise. Payrolls tomorrow morning. Your bond market yields pulling back by 2 basis points. Go away. 432.93. Trying to tee up payrolls, robots.
Know, but you know, this is real.
The opening bell, 34 minutes away from New York City. This, we're going to do better tomorrow. This was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
I think I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. Very good morning to you. Fear not, those rate cuts are coming. We're bid again in the stocks, 5,300 on the S&P 500. The soothsayer Powell comes to the rescue in the week. We'll count down to the open. Kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up in the show, futures edge higher, as I say, the Chair Powell sticks to the script. The Fed reassuring markets that rate cuts are on the way, and investors shift their focus now to the data. Payrolls in sight. That's next. We begin with the big issue. Chairman Jay Powell to the rescue.
These recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path.
That bumpy path. Let's debate that. Mike McKee is with us. Mike, we just had the weekly jobless claims, not exactly out there on a limb, but we are reassured by the narrative from Jay Powell and others.
Yeah, well, there has been a lot of Fed speak over the last couple of days, and there's even more coming. We're going to call it Fed Stock, a festival of Fed speak. This is who's speaking today. You've got 7 different Fed officials, not all of them speaking on monetary policy. Alberto Musalem is offering his first remarks ever, but there's supposedly welcoming remarks from the new St. Louis Fed president. But a lot of people will be telling us what they think. And if you think that's bad, tomorrow we follow up with another 6, because basically everybody wants to get in on the act, and we should have a pretty good idea of what people are thinking by the end of tomorrow. That will, of course, be affected by what we get in the jobs report tomorrow. You mentioned claims going up a little bit. Right now, we are looking at jobs on tomorrow and May 3rd and June 7th. CPI 3 times also before we get to the June meeting, and PCE twice. So the 2 meetings we've seen go up and down in terms of Fed funds futures, in terms, you know, what they think is going to happen, traders. And we'll probably get a lot of volatility with all of this data coming in, and Powell insisting it is on the data. But you mentioned Powell reassuring. Here's the funny thing. He said the same thing yesterday that he said last Friday, and look at the difference between trading Monday and trading yesterday. On Monday, everybody sold off. and we gapped down on Tuesday. And then look what happens when he speaks on Wednesday. The market finishes higher. So same message, different interpretations. It's going to be fun to watch what happens today, and even more fun to watch what happens tomorrow.
To be fair, we did have prices paid, and we did have ADP, and we had wages. If you change your job coming in at 10%, we had a lot thrown at the market yesterday morning. That was all before Powell spoke. Mike, thank you so much. Mike McKee. A little bit earlier, I caught up with Alfonso Picatiello of Macro Compass. His rationale for the Fed's outlook is this.
The Federal Reserve is talking about cutting interest rates about 3 times this year, and maybe 3 to 4 times as well next year. So it's a proactive cutting cycle that is happening again on the backdrop of what? Well, core PCE is annualizing 2.5%. The job market in the United States is not weak enough to generally come with a cutting cycle. So the private sector is adding over 200,000 jobs on a 3-month rolling basis as we speak. And nevertheless, the Federal Reserve is talking about interest rate cuts. This time not because the mortgage market is under pressure, but most likely because of politics, if you ask me.
Proactive rate cuts driven by politics in an environment with job growth, higher PCE, no real reason to justify a cut. Joining me now to debate that issue is Peter Cheer from Academies and John Hancock's Matt Miskin. Good to see you both, gentlemen. Peter, good morning to you. Let's go to you first of all. Alfonso was referring back to 2007, a 15-month pause, cutting 50 basis points. There was a subprime crisis. My challenge to him was, it's not 2007, and hence he says it will be proactive and it will be politically driven. To what extent will it be proactive and politically driven in terms of rate cuts? Good morning, Peter.
Yeah, good morning. Tough questions. I think we'll probably see 1 to 2 cuts. I'm guessing June and July. Partly, I think they want to get some cuts in. You know, they're going to say there's a lag time, all those things. Powell seems committed to it. And I do think they want to get something, you know, bolster for the economy ahead of the election, but not too close to the election. I think they would really like not to have to do anything at the September or November meetings right at the heart of the election. So you get 2 cuts out of the way, June, July, we move on from there. I don't think he's going to be right on the data. I think he's going to turn out to be wrong, much like he was wrong on transitory, and that's going to limit their ability to cut going forward.
And I did have another guest this morning who basically said the Fed, in terms of their forecasting, has been abomination and wrong on a permanent basis. Push back slightly on that. Good morning to you, Matt. Good to have you with us. You would not be surprised if there were cracks that develop over the course of the year. I'm fascinated to know where those cracks are. I had one guest that says the cracks will appear in Europe in the credit cycle there and not here in the US. Where are the cracks going to appear, and what makes you slightly more hesitant?
Well, it's just hard to understand Powell's perspective at this point. If you're going to revise up inflation expectations and you see copper prices rising, oil prices rising, which is likely to feed into inflation as the year goes on, it's hard to understand the perspective. And I think right now, when we look at across the U.S. economy, one of the things that is weakest is the commercial real estate market. And we do hear about massive write-downs in the commercial real estate properties in some of the major cities. And I think Powell might be sensitive to that. And it's just hard because what you're doing is you're trying to put out a smaller fire before you have to put out a bigger fire. But what is really counterintuitive about this economic cycle is usually you wait till things get worse so you have dry powder to cut, similar to the government. We're running a massive fiscal deficit right now. Usually you wait to the recession to use counter-cyclical measures. We might not have much dry powder because we're already spending massive amounts out of deficit, and the Fed is already talking about rate cuts, pricing that into the market. So I would wait, but that's not what we're here more to invest and just take it for what it's worth. But it's likely beneficial to markets. You see the Fed already easing or talking about easing when the growth is this strong.
Well, then let me ask you both this question. I mean, at one stage, 24 hours ago, I just want to remind everybody, 24 hours ago, this bond market was up 22 basis points and going higher, okay? 24 hours ago, there was a palpable sense of tension in this bond market. How much and to what extent did that unnerve you, Peter? And did you say to yourself, there's something more going on here than just perhaps a tentative repricing?
Yeah, so I think one thing we really got to pay attention to is the Fed job owning is only barely affecting the front end of the yield curve anymore, right? We're not pricing in 5 cuts. We're not pricing in only 1 cut. It's been in this 2 to 3 sort of range for quite a while. So what I think we're going to start seeing is much more a steepening of the yield curve as we get back to the issues that are facing us, right? This rising deficit, And as other guest just mentioned, right, we are spending more even in good times. We spend even incredibly amounts more if we have bad times. So I think you're going to see yields push higher. It's bouncing around a little bit on Powell noise. I think it's really tied to crude. It's tied to energy. And I think there's a perception settling in, which I agree with, that there's going to be inflation pressure coming from the energy sector, whether it's geopolitical, whether it's the usage that's coming from data services, AI, EVs. So I think there's going to be a steady stream of inflation pressure. That's going to keep us above 2%. That's going to limit the Fed's ability. And you're going to want a risk premium at the long end. So I think we get to 450, 460 on 10s, even without the Fed changing its mind on cuts.
Well, here's the thing to both of you. You know, we had a bit of a shakedown in the bond market last autumn. That was over fiscal concern. We're in an election year. We're not going to blow that up at the moment. So here's the issue. I haven't seen any kind of buyer strike in the corporate issues that we've gone on through the year. I haven't seen any kind of buyer strike in the bond market so far in 2024. And everybody's telling me there shouldn't be one, that I want to pick up IG, I want to pick up the yield, want to clip the coupon. So, I put it to you, Matt, that this bond market for now, and I can't project the future, for now, doesn't really care about the fiscal irresponsibility of Washington, for now.
Yeah, and when you look at high yield spreads, to your point, high yield spreads are now basically 300 basis points or 299 basis points at the end of the quarter. So that's the additional yield you get for a high yield or corporate junk bond relative to treasuries. And that is of the lowest in history. There's only 10% of instances over the last 30 years where high yield spreads have been that tight. We ran analysis looking at the subsequent one-year return after high yield spreads are that tight. The subsequent one-year total return is basically zero. And you lose, in addition to the 7% yield, 8% yield right now, with price declines in high yield. So it's priced for perfection, Manus. And what we're trying to say is we would trim into that. It's asymmetric. Your upside is maybe 25 basis points of spread tightening on high yield. And your downside is 800 basis points. I mean, you could go up to 8% spread wide. So we've been underweight high yield. We think that it's priced for perfection. But you're right that the market is very confident in the strength of this economy, and that's being reflected in the spreads.
And listen, long may the confidence, remain. Long may the unemployment stay low. Let's hope that we don't have a massive interruption in employment to temper inflation. Peter, I want to talk to you about your perception of what a rotation or a pivot is. You say this: rotation will be looked at a bit more broadly today. Yes, it will incorporate what we typically think of as rotations, but it will be broadened to encompass pivots and evolution, if not rethinking. What is your biggest rethink? I mean, there's a lot to contend with there, so I want to go straight to the end. What's your biggest rethink? Because you're still quite doomster on NASDAQ and bid up on energy. So what's your biggest rethink?
So I think the biggest rethink is actually comes down to the Fed, where it's clear that they're trying to come up with excuses to be able to cut. Right? It's if they stuck to any traditional metrics, if they stuck to long-term averages, all these things that they talked about before, they've kind of pivoted away. They are definitely trying to come up with excuses to cut. I'm not sure they'll be able to deliver on that, but that's definitely something I'm thinking about. The other rotation is I really liked energy. I actually do like Chinese stocks more than NASDAQ. That's actually worked reasonably well for the past 2 months. I still think that's where the froth or issues are potentially on those AI and the stocks that have been deputized into the AI space that have really rallied quite strongly. And I think now we're going to be that moment where it's push comes to shove. Are companies really getting a good cost benefit at today's AI technology, at today's prices of AI? Or are we going to see a bit of a pullback like we've seen in some other big success stories? I'm not quite prepared to go all in on the Russell 2000, partly because, as other guests mentioned, commercial real estate does seem to have some problems. On the other hand, I'm quite fine with credit. I don't think we're going to see problems with credit. One thing we're still all trying to digest is the impact private credit is having on this market. And ultimately, I think it's actually a good thing for markets. And it's also why I don't think CRE is going to turn into a real problem. I think it's just going to be a slow bleed that banks can deal with quite okay.
Yeah, I would encourage everybody to go back and listen to Jerry Keefe from HSBC. He was in the seat this time last week, and he basically said he felt that the worst had passed in CRE. HSBC writing down the total size of their exposure by 27%, really trimming back the book. Matt, you're both in syncopation on one thing, on energy, and it's a building narrative from everybody, which is about breadth, it's about oil prices, but you say that there's good cost discipline in the energy sector, and the dividends will pay handsomely.
Yeah, I mean, I in a former life was an energy analyst, and back in those days, the dollars that came in for these companies, they were often deployed into going in and producing more oil, and that was counterintuitive in a way because that brought in more supply and that lowered oil prices, and then that was a feedback loop. Now they're saying we're not going to increase production. We're not going to, they are basically taking on production that OPEC has stepped back from.
Yeah.
But you're not seeing this, you're just seeing great cost discipline. You're seeing high free cash flow. They're cheap. They're paying good dividends. And they would be, if you see a rotation, energy is likely going to be the bracket buster of the March Madness. It's now the second best performing sector year to date. Communication services #1, but tech, which is the #1 seed in the March Madness or the tournament here, is starting to get tired. And a lot of great news is priced in. And so you could easily see a rotation that would help value stocks. More broadly, energy is going to be a big overweight in value versus growth. And it would be a bit of a 2022 type scenario. You might get some of those vibes coming into markets this year.
Okay, don't be ashamed of your former life in energy. I'm an OPEC reporter, and it is a blood sport, and a very enjoyable blood sport at that. Stay with me, Peter Cheer and Matt Miskin, my guests. Quick snapshot of what's going on with Paramount before we hop over to Abigail. Take a look at this. We're now down 5.77%. You got Redstone doing a tentative deal to sell their Paramount stake to Skydance. So this is an exclusive period of time. They're going to have this conversation. Redstone, of course, has the controlling shareholder of Paramount. So we're going to keep an eye on this stock. Paramount owns CBS, MTV, and the studios. It's the studios that could be the jewel in the crown, but the stock is down 5.4% at the moment. Let's get across to Abby. She's with me for ahead of the opening bell. What else have we got in store, Abby?
Well, we have some stocks moving to the upside, Manus, and overall right now the U.S. futures are higher as well, helping out shares of Levi. They beat estimates both top and bottom line. This is revenue fell less than expected. Apparently baggy jeans and denim skirts are back in vogue, helping out. Now there is also an 11% short interest here, so I think this is a bit of a short squeeze. Micron up 1.4%. Yesterday, of course, there were fears that the supply chain for chips would be affected by the worst earthquake to hit Taiwan in 25 years, but TSMC quickly came out and said that they were going to be able to resume production. They have done that, so we're seeing a continued rebound for chips. Block down 2.7%. Morgan Stanley has downgraded to underweight, or basically the equivalent of a sell on what they say is limited upside. This stock now set to be basically flat on the year, Manus.
Baggy jeans. There's a thought. Abigail, thank you very much. Abigail Doolittle. And coming up, Secretary Yellen touches down in China.
We've agreed that it's important to both of us that we don't want to decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field.
The latest on U.S.-China trade relations. More on that conversation in just a moment on Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap. as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
We've agreed that it's important to both of us that we don't want to decouple our economies. We want to continue, and we think we both benefit from trade and investment, but that it needs to be in a level playing field. We went for too long with too little communication, and misunderstandings developed.
Secretary Yellen touching down in China. It is her second visit in 9 months, coming as the trade tensions intensify. Secretary Yellen suggests that the U.S. will retain options to protect new industrial sectors against Beijing. This with a number of big meetings still to come. Joining me now is Anne-Marie Horder. What does level the playing field mean? Good morning.
Good morning, Mattis. Well, I think it was interesting in what Secretary Yellen had to say as she was making her way to China. Now we understand and saw pictures of her touching down in China. Is this line, when she was talking to reporters, she was talking to the fact that they want to try to nurture an industry when it comes to solar, electric, et cetera. And then she goes on to say that they wouldn't want to rule out other possible ways in which to protect them in the United States. So she's insinuating the U.S. could potentially add more, say, to tariffs or other provisions. We do know that the Commerce Department in the United States is looking into potential national security concerns when it comes to China EVs and connectivity issues. So this is where the United States is at this moment. But this is her second trip that she's making to China, and she has also talked about potential misunderstandings within the relationship, which is why she sees communication. But you have to think there's a big gap between China and the United States in terms of what they see as level playing field, given the fact that China says that the United States is acting in a protectionist way, which many are calling rich, and they filed a complaint to the WTO.
Yep, well, it's certainly going to rankle on, isn't it, Anne-Marie Horder? And on the very latest Yellen visit to China, my guests are Peter Cheer and Matt Miskin. Peter, you make it very, very clear that you're still concerned about tariffs. We have live tariffs from the Trump era before. You have the risk of enduring tariffs and no off-ramp, and that is a challenge, isn't it, Peter?
Yeah, when I'm watching the clips of Yellen, I really keep thinking having our cake and eating it too. I think it's just unrealistic in what's going on in today's economy that we are at friction and odds with China in so many ways. Even if you look at CISA published on the Volt Typhoon hacking thing, they don't just say state-sponsored actor, they say People's Republic of China state-sponsored actor. So we're going through this. You watch what China's trying to do even in terms of spectrum. They're trying to get 5G and 6G to push into spectrum that we currently use for radar. There is so much friction on the AI, high tech. I don't think there's any way to have normal relations. And I think flipping it around, what I'm watching this push made by China, where on the previous segment you were talking about BYD, right? BYD is becoming a household name. You're going to see Chinese brands push into our sales. I think it's all-out competition, and it's not going to get better.
Matt, in terms of these pieces of theater that we see, Yellen arriving in China, it is to stabilize that relationship. China has promised to hit 5% growth target. Suddenly, we are talking about China during this opening market bell in America. So how relevant is China to the narrative for you for risk 2024, for the remainder of the year?
Well, the economy seems to be picking up, at least when you look at the purchasing manager indices, and they did a lot of stimulus. I mean, you could say that they didn't bring out the bazooka, but they certainly brought out enough stimulus to get the economy starting to recover. They still have a massive issue with the real estate market, and they are becoming much more how do I say this politically correct? Less capitalistic, we'll say. And I think you're getting more state and government intervention in the private market. And we look at earnings estimates. It's really hard to get an edge on the geopolitical backdrop on this and the macro backdrop, but we look at earnings. And you got to just try to keep it simple. Look at global earnings. Earnings revisions in emerging markets and in China have been sideways for a better part of a year. It's been hard to see earnings growth. And so the best earnings growth is still in the United States. That's where we're overweight. And those companies to us are going to be the leaders because earnings are going to be really important as the year goes on.
Well, it was supposed to be that we were all not Sinophile enough when it comes to Apple from Wedbush Securities, making Apple worth $4 trillion, and that narrative has significantly changed. Matt, thank you very much. Matt Miskin, Peter Chair, on the markets this morning. Coming up, your morning calls. I will also catch up with RBC's Amy Wu-Silverman. She'll explain the positive sentiment that she's seeing through the options market. Guess which prism she will use? NVIDIA. That's right. Right here on Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We're bid up this morning because the narrative from Jay Powell over the past 24 hours is that the rate cuts are coming. The bumps you've had in inflation are only temporary. Check out Palantir. It's one of the big risers this morning, along with Oracle. They have a new venture together with the government. They've got more government contracts. You're also seeing 5,300 big psychological levels as we go into jobs day. We've had a small bounce in the jobless claims. Nothing too serious or injurious. Time now for your morning calls and what the analysts of Wall Street are writing about. Morgan Stanley downgrades block to underweight, seeing limited opportunities for growth within the company's cash app. Next up, Goldman Sachs upgrades Ava's budget to neutral, highlighting the company's attractive balance sheet, smaller exposure to electric vehicles. UBS downgrades Bank of America to neutral, expecting limited upside after rallying 12% this year. It's Amy Wu-Silverman. She's with me next. No sign of irrational exuberance, at least not in the options market. How are your skews? They are bid up for calls and they're bid up through the prism of NVIDIA. Fear ye not. The options market is lit for a rising market. Good morning from New York.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Could face bigger challenges next. It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
To what extent is this renaissance in the equity market as we go towards the jobs report a view that the rate cuts are coming, the inflation bump is temporary, and that you will have proactive, scalable rate cuts from the Fed as you had in 2007? No, you don't have a mortgage crisis at the moment, but that there will be reasons for the Fed to cut hard and cut heavy. There is the opening bell. You see Palantir bid up this morning. Tesla trying to hang on to staff and paying up and looking large. There you go. And also the Russell 2000. This is your best performing index at the moment, up over 1%. That is predicated on the rate cut narrative. Now, euro dollar is also up as the dollar, you're just seeing a bit of a roll down in yields. Don't forget, 24 hours ago, 10-year government bond yields were up 22 basis points. You then had Powell come in, say, take some heat out of this scenario of rising yields. Crude is flat at the moment, but you're just off a 5-month high. Couple of stocks to keep an eye on. Have you ever had a pair of Levi's? I have. The retailer's cost-cutting plans seem to be working as it reported higher than expected sales and profit. Abigail Doolittle is with me. What's selling hot at Levi?
Well, Manus, as we were talking about earlier, baggy jeans and denim skirts are back in. In fact, the new CEO, Michelle Gass, she's really focused on fresh merchandise. So that's a piece of why revenues beat estimates, declined less than expected. But the other big piece of what's happening here, cost cutting, and that was announced back in January that they were going to focus on cost cutting and productivity. Apparently, some of those measures have worked out. They beat earnings by double digits. Not a huge number, but moving in the right direction. Wholesale was a bit weaker, but they're hoping to improve that. Lots of Wall Street banks raising their price target on the shares of Levi, perhaps thinking that this turnaround is going to take hold. I would say one of the big factors, though, here on this 17% gain, the best day going back to March of 2020, that's the degree of buying power that we had in that pandemic bottom when investors really came in. Well, it has to do with an 11% short interest. So we have a bit of a short squeeze here, Manus, but you know what? Big gains and, yeah, baggy jeans.
I tell you what, they had the most iconic advertising campaign in 1985 that was revolutionary. Go and Google it. The name of the campaign lead was Nick Kamen, and it revolutionized advertising for jeans. There you go. Fact of the day. Let's stick with the earnings front. ConAgra jumping after rising and raising its annual margin outlook. That was amid resilient demand. Simone is with me. So this is all about the commodities and the margins.
Yeah, that's right. Margins was a key focus for the maker of Slim Jim, Ready Whip. Margins coming ahead of expectations for the quarter, over 16%. And the company able to revise up its full year expectations to 15.8%. It had seen about 0.2% lower than that. But remember, these were revised down last quarter, and that's what led to a pretty negative earnings last quarter. I think the bigger message here is that the volumes overall, those volume declines, they appear to have slowed. Volume down 1.8% in this last third quarter that ended in late February. And what's interesting is where this revenue is coming from. It's all about grocery and snacks. That was the key segment that led that revenue growth. Citi said they were a bit surprised at just how strong this segment was, especially since it looks like they were able to pass on some price increases to consumers. They want to know on the call that's just started now exactly where that's coming from. This was, however, offset to some degree by refrigerated and frozen foods, food services sales all declining. What's interesting here as well on a consumer basis is that month-on-month food inflation for people eating food at home has finally started to decline in the last month. Does this push more consumers to ConAgra? Right now, the street's pretty excited about these results with the biggest gains on an intraday basis since March 2020, Manus.
Simone, thank you very much. All about the snacks. Let's turn to tech. Alphabet is considering charging for web searches featuring powered generative AI. That's according to the FT. Ed Ludlow is with me. Ed, this has my mind turning around the monetization of AI, and they're starting early, or does it send a different message?
It's the bread and butter ad business that the street is so focused on. The stock's down 1.4%, 1.3% as we speak. In the FT report, they state, according to their sources, that while engineers are working on the idea of adding AI-powered search to an existing premium subscription product, executives aren't yet sure if they want to deploy it. And what a spokesperson for Google told Bloomberg was that they are not working on an ad-free search, which seems to be the key point of differentiation here. In other words, if they went through with this and had a paid-for higher tier search, ads would still appear alongside it. There is a premium subscription product that already exists out there, $20 a month in the United States, where you get the Gemini model-powered AI functionality for existing Google products, Gmail, Docs, things like that. But this has long been the story ever since ChatGPT came out in November of 2022 and the subsequent updates that have followed. The future of the core search business has been the big question mark. And when we talk about whether or not Alphabet and Google have fallen behind Microsoft, its investment in OpenAI and what it's doing with its cloud-based software platforms, it's the search domain where we're most focused. You have other startups like Perplexity that are increasingly gaining notoriety as well. Stock down 1%, Manus.
Okay, Ed, thank you very much. One stock which is in free fall at the moment. We touched on it earlier. This is Paramount. Now, the entire story here is about who is going to get their hands on Paramount. Think about CBS, MTV, the studio lot. At the moment we have Redstone, we understand, potentially doing a deal to sell their block, a tentative deal to sell Paramount's stake to Skydance. Stock is down 9%. Why is that? Is that to do with an unhappy set of bedfellows that a deal won't go through, but down by 9% raises big questions about how this is going to be funded. You've got Redstone as the controlling shareholder of Paramount, and we have got these exclusive talks. As we get a little bit more detail on that, of course, we will track it for you. Let's get back to the earnings season. BlackBerry reporting a surprise profit with cost-cutting measures paying off. Isabel Lee has more on the story as well.
Hey, Manus, the stock is really fluctuating. In the pre-market trading, it was up as much as 8.5%. It opened in the red, and now it's up again, 3.5%. I think it's really a push and pull between outcome and outlook. So the company reported a surprise profit in the fourth quarter, and that's after analysts were estimating a loss. And a large part of this is really demand for its cybersecurity services amid a growing slew of online crimes and high-profile hacks. So revenue was $173 million. That's compared to the $154 million estimate. So in the cybersecurity unit, revenue also rose 5% to $92 million, and the Internet of Things revenue rose 25% to $66 million. So it was a good quarter, but to Bloomberg Intelligence, the outlook just really fell short, and this really highlights how the company is trying to move forward after a difficult restructuring. Recall that in February, the company laid off and exited some offices, laid off people for that matter, and in December, they scrapped IPO plans for its Internet of Things security unit. So BlackBerry, looking ahead, sees revenue for the first quarter to be between 130 to 138 million. That's lower than estimates. And revenue for its cybersecurity unit and Internet of Things units were also lower. But shares seems to be holding up. They're up about 4%, Manus.
Okay, Isabel, thank you so much. My next guest says this: as I have often joked, the right tail is the new left tail. That said, we are seeing substantial activity in gold in the complex there, as well as energy. Amy Wu Silverman is equity derivative strategist over at RBC Capital Markets. I'm inverting the conversation. We should be starting with a broad breadth on the equities, but I am drawn to this because guest after guest after guest is telling me they want to be long energy. My guests earlier both want to be long the energy complex. Gold has made a record high. My inbox is piling up with calls on gold. Just extrapolate for me, this right tail is the new left tail. Good morning.
Good morning, Manus. So, you know, look, here's my theory on what I think is happening specifically as it relates to gold and energy. You know, one thing we've talked about, kind of a key theme in the options market, is the left tail is largely absent. And simply what I mean by that is folks just haven't focused on hedging. They haven't focused on downside. Here's what's interesting. I think what we're seeing in gold and energy is to some degree hedging the left tail, but by using the right tail in gold and energy, because these are plays you would do if you're worried about geopolitical risk, plays you would do if you're worried about inflation. But we're seeing it much more through these channels than something more traditional like S&P puts.
Are we so captivated by the bullish equity narrative, AI earnings, and extrapolating forward that we, as a market, have been moderately irresponsible in attending to the left tail risk? Are we underhedged?
Yeah, it's such a great question. And here's what I would say. I think the game is a little unfair right now. And what I mean by that is when you just look at the breadth of the equity market, right, that bad breadth in the equity market, the concentration in a handful of names, even if you wanted to hedge, you're not really getting the proper exposure that I think folks want. And that's why I think, you know, that left tail has largely left the S&P, but it's not that it's gone away, it's that it's found other channels to go through. And I think that's why people are going to these energy upside plays, and I think that's why people are going to these gold plays. It's not that there isn't worry in the market, it's that you have to put that worry somewhere else if you want it to play out properly.
I mean, I would say this week we've had a few moments of angst, not existential angst, fairly moderate moments of reflection. When you see a bond market up 22 basis points, an equity market a little bit under pressure. So the debate is this, as to whether momentum is running short of breath.
Yeah, so one way that we look at this angst, for instance, or this lack of angst is what we call skew inversion. But put very simply, where is that sentiment in terms of demand for calls for that upside versus for puts for that downside? And we use NVIDIA as a proxy, of course, because that's really been the bulwark of your AI theme. And what we'll say is we're far below the peaks. We kind of peaked in early March, if you called that the 100th percentile, but we're also nowhere near, you know, down and dead in terms of being depressed. We're still exuberant. We're kind of in the 50th percentile. And the other really important thing is we're still above where we were in May of last year when the AI frenzy kicked off. So look, exuberance has waned, but it is still there. And people are not protecting their downside in NVIDIA. This is a stock that has done remarkably well. Usually people just protect their portfolios. We are not seeing that. There's still that chase for upside. That momentum is still there.
Is that not reckless?
You know, this is something that I started to say a few years ago when the AI theme, you know, came to fruit, was just, I think it could be possible that there is a secular theme going on that will be agnostic to what is going on in rates. And so it's simply a question of there is a paradigm shift how does that play out in the market? Sort of the same idea as post-1998, post-1999. And I think the way people think about that is, again, it's not that that worry isn't in the market. It's just not something they're going to express through something like NVIDIA. I think you're going to see it play out in the other sectors. And so that's why you have to be a little bit more nuanced when the concentration in the market is leading you one way, but the worry is there. It's just under the surface.
I think you've just given me the phrase of 2024, a paradigm, a shift in the equity market, which is almost agnostic to what's happening in the rates. That is fascinating, which then takes me to, you talk about FOMO and MOMO. I'm curious to know what MOMO is. I understand FOMO. I have it every day when I look at NVIDIA, and I hope that it's part of whatever funds I have out there. What is MOMO?
So I think MOMO, I guess, is your more quantitative way of capturing the FOMO. Unfortunately, Daniel Kahneman just passed away, but one of the greats in terms of defining behavioral finance, right? So momentum is really simply the idea that price performance begets more price performance. But what's the underlying behavioral science behind that? It's the FOMO. It's a quantitative way of thinking of that. We can actually factorize that. And actually, if you go to your Bloomberg terminal, MTUM, right, you look at the different factors that are playing the market. The best performing factor is momentum. It's simply this idea that price performance has been begetting more price performance, largely driven by the AI trade. But what's the behavior from humans that's causing that? It's your FOMO.
Those humans, they get in the way of the algos. That's the disruption that we have. Listen, Amy, thank you very much. Great conversation, and I think defining where we are in some kind of paradigm shift. To quote one of the central bankers of old. Amy, thank you very much. Amy Wu-Silverman of RBC Capital Markets. There's no slowing down on the skew for your NVIDIA. Coming up, Apple, they're moving into the next big thing.
As a project, the car initiative was just a drop in the ocean in terms of cost. Apple has not lost their mojo. They either do things perfect or they don't do them.
Perfection is a very hard space to live in. From cars to robots, we discuss Apple's strategy. That's on Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
The moment news breaks, no one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
The positive news here is Apple has not lost their mojo. You know, they either do things perfect or they don't do them. As a project, the car initiative was just a drop in the ocean in terms of cost. We're still facing a situation where Apple is not a high growth business, and valuation is a bit of a challenge in these circumstances.
So Apple switching gears after ditching its plans for its autonomous car, moving to robotics, which the company believes has the biggest upside potential. One project in the works is a mobile robot capable of following users around their homes. Mandeep Singh is with me now from Bloomberg Intelligence. So this seems to have mystified a few people, but for me, it appears quite straightforward. Robotics, given aging population, healthcare and fiscal needs. This could be part of a much, much bigger solution for an aging demographic.
Yeah, and look, Apple has the install base when it comes to the developed markets. I mean, with the smartphone and the PC install base they have. And I think it makes logical sense to extend their smart speaker into something like a robot, which you can chat with. I think voice is going to be key when it comes to interacting with any robotic form factor. And I think we've seen that with Tesla, Optimus. I mean, basically, you're talking about applying AI inferencing to a robot form factor. And it remains to be seen, you know, what Apple has done on that front. But it makes a lot of sense for them to tie this to their smartphone and then the PC install base they have.
And would you agree with the thesis that this is taking a lot of the construct that was within the car project and taking that data, that information, and those constructs and transferring them up and into robotics?
I think, I mean, there could be some leverage over there, but to my mind, if they have to build like a proper robot structure, their value add is in, you know, the ecosystem they have. And I would rather see them partner with someone like Boston Dynamics or, you know, somebody who has that manufacturing ability when it comes to the robot side. It's very hard to figure everything out on your own, and I think that's probably what they realized with the car project as well. And partnerships to me is the key, whether it comes to the AI side of things or actually manufacturing the robot form factor.
Now, we've also had a story overnight from Alphabet talking about monetization. This is an FT story talking about the monetization of using AI. Is that a departure? I mean, we've had Ed with us this morning talking about the departure from the traditional advertising, high advertising revenue model. But isn't this just about the infancy of understanding how to monetize AI in a broader way?
Yeah, you bring up a great point. Look, the traditional search has a very different gross margin profile than generative AI search. And we realize, you know, how the high compute costs make the search less attractive from a monetization perspective. And we don't even know, you know, what kind of ad loads you will see in a generative AI type of search response where you have got more summaries. You're talking about generating more images and videos using prompts. One thing is for sure, the search market will probably grow much faster than it has in the last 2-3 years, simply because with longer prompts, one of the things you will get is people searching more. And I think that's something where it can benefit Alphabet if it has a subscription model. And they've done that successfully on the YouTube side. I mean, YouTube was a freemium model to begin with, but look at how far they have come with YouTube subscriptions. It's almost a you know, a $12 to $14 billion run rate. So I wouldn't be surprised if they're able to do that on the ad side as well.
Okay, Mandeep, thank you so much. The stock is down just under 2%. And we have a little bit more breaking news on Alphabet. And this is what we've got. The Google parent of Alphabet in talks with its advisors about an offer for part of the business. It's called HubSpot. This is a marketing, an inbound marketing software business. This is a Reuters headline. Alphabet has met with Morgan Stanley bankers in recent days, the story says, and they are discussing how much it should offer and whether antitrust regulators would clear such a tie-up. So that's the very latest line for Alphabet. In talks with advisors about an offer for HubSpot. Okay, sector price action. Abby's with me.
And Manus, it's worth noting on that breaking news, we do have the shares of Google or Alphabet, I should say, at session lows down more than 1%, as is typical for the acquirer, and HubSpot up more than 9%, its best day in more than a year. Now, relative to that sector action, take a look at the S&P 500, up about 0.7%, the best sector, real estate. This is yields are down. Those dividends look a little bit more attractive. Pretty broad-based rally, industrials, financials, tech, all higher, and really all 11 sectors are higher. That bottom line that's in the red, that's a non-classified area, so it's not actually a sector. As for one sector that's up for a second day, despite the worst earthquake to hit Taiwan in 25 years, the stocks chips up 1.3%. And this, of course, after TSMC was able to relook at the situation and resume production there. So the fears that the supply chain for chips would be hit, well, that really didn't happen. And we have the stocks again up over the last 2 days, up 1.2%, Manus.
Okay, Abby, thank you so much. We'll track that Alphabet HubSpot story as we go through the morning. Coming up, market moving events for your day. A little bit of Fed speak.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Do you believe in rate cuts? Do you believe that the data is going to embolden more rate cuts? Jay Powell says, don't worry about the bump in the road. Look at this Russell 2000 up 1 1/8 at the moment. You've also got Meta at the bottom of your screen doing quite nicely. They had a bullish call from Wells Fargo on that stock. But again, tech is strong. We've had a bit of a deal flow through this past 20 minutes from Google on HubSpot. We'll have more on that through the rest of programming. Here's what your agenda looks like. Fed speak, Harker, Bark, and Goolsby throughout the day. Friday, we wrap up the U.S. week with payrolls. That is a globally, systemically important event. Moving on to next week on Monday, anticipate a solar eclipse. Wednesday, CPI. That's it for Countdown to the Open. The Bloomberg team take you through the rest of the trading day.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. Your fixed income fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast, Bloomberg Global Radio. Find us there. Alex Steele and Paul Sweeney with you here. Bloomberg Intelligence. We like to focus on companies. We like to focus on individual stocks. We like to rely upon the many analysts, over 400 investment professionals at Bloomberg Intelligence, covering 2,000 companies in 130 industries on a global scale. You hear us interviewing and relying upon them heavily as we try to break down what's happening out there in those markets. Coming up, we're going to talk to Geetha Ranganathan. She runs all the media research at Bloomberg Intelligence. We're going to talk Paramount. We're going to talk Disney. We're going to talk, does Bob Iger have a successor yet? Todd Becker, president and CEO of Green Plains, is going to join us to discuss his company's partnership with Shell. I think Alex may have had a hand in that.
Todd's great.
Very cool.
Todd's
Awesome.
great. He says it like it is. Ethanol company trying to be ag tech. Super
Got it.
cool.
Awesome. And then we got Eric Schatzker, Bloomberg New Economy editorial director. He's got a great story out on the Bloomberg terminal today, the big take story, talking about what happened at Hertz. The hubris at Hertz doomed its massive bet on 100,000 Teslas. It's a great read. We'll get Eric in here for all the reporting. Let's kick things off this hour, though, with Mr. John Tucker of Bloomberg Business Flash.
All right, and we've got green on the screen. Stocks pushing higher, Paul and Alex. You have 10 of the 11 major industry groups in the S&P 500 up. Real estate, information technology in the lead right now. And ahead of the jobs report tomorrow, initial applications for U.S. unemployment benefits rising last week to the highest since January. So that's more evidence the Fed does have reason to cut rates. And John Stolfus at Oppenheimer says the economic backdrop can push the S&P 500 to close the year at 5,500.
Business is showing that it's resilient. The jobs market is showing that there's resiliency. The consumer has slowed, but the consumer is still relatively resilient. So we just think if you get sustainability of resilience, that's the new operative phrase.
Right now, the S&P 500 up 36 points, a rise of 0.7%. We're at 5247. The Dow Jones Industrial Average up 166 points. The Nasdaq 100 up 158 points, a rise of 0.9%. Two-year yield right now unchanged, 4.67. The 10-year, that's 2 basis points lower. That's at 4.32. And Levi Strauss reporting higher than expected sales and profit in the first quarter. That's helping fuel a more optimistic full-year outlook. And then some breaking news about HubSpot. Reuters saying Google parent Alphabet has been talking to its advisors about the possibility of making an offer for HubSpot. Shares of HubSpot right now, ticker symbol HUBS, they are up 7%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Is that what is that? Oh, software company.
They provide a cloud-based customer relationship management platform, CRM.
Wow. Oh, okay. Thank you for that.
Yeah, I
for
can
some
read off the
reason,
screen.
I was like, did they sell tickets like Hub?
No, that's something else.
Yeah, that's a
and
different
that's involved in like a
that's something else.
antitrust suit, I believe, right?
Cool. Anywho, hello, John Tucker.
Hi.
Hi. Happy Thursday. We made it almost to Friday. Maybe
Yes.
the deluge here in the
Hopefully
city is over. I don't know. That wind yesterday, are your houses okay?
Tucker, you're on the top
well,
of the
yeah, not really. I'm on the windiest spot on the East Coast of the United States. So I think power has come back since I left. But
it was crazy.
Took a shower in the dark this morning. Tried to shave in the dark. Doesn't work out real well.
John Tucker looks fine.
There's
no bleeding. There's no issues there. Anyway, to the market we go. I gotta say, I'm really focused on gold here. I read column after column about why is gold going higher, and all the gold bugs don't seem to get it. And that makes me scratch my head a little bit.
And we had Gary Schilling on. I mean, he's been doing this forever, and he doesn't know why it's going higher. So, but we had that 2-second meltdown a couple days ago. Now
literally 2 seconds.
Now we're right back up.
Which leads us to Abigail Doolittle, who follows everything markets here. Has that little teeny tiny little meltdown, is it over now?
It's hard to say. I think that it could be near-term support is holding for the uptrend, but the uptrend, on the other hand, relative to the Nasdaq 100 and even the S&P 500, is starting to waver. A trend line on a chart is never to actually show the trend. You can just see that. The purpose of a trend line is to show when the trend breaks. And if you do a trend line for the Nasdaq 100, it's been breaking for more than a week. So even though it's been a little mini pullback, and maybe we see a little bit of a rebound here, it suggests that there's uncertainty, weak buying, and that there could be some actual real selling ahead.
Are you surprised that we didn't see more follow through on some of that weakness we saw earlier in the week? It's it feels like the market's waiting for it.
Yeah, I think that there is going to be some sort of an actual correction ahead that will be healthy. I think we talked about this yesterday, the day before, that if we had 5-10%, that would actually be healthy, given how fast. That would give some stability to the buyers. When that happens, it's hard to say. I mean, we do next week, of course, start to get more inflation data. And, it's at the end of the day, it's really going to come down to the Fed. Although that said, we do have the first quarter earnings season starting soon, so it'll be interesting to see what comes out of that reporting period. That could also provide some kind of an element to cause people to want to take profits after such a big rally.
And of course, whenever you have any kind of movement lower, then you get Goldman coming out with their CTA note, which is like, hey, if the selling persists, you could see CTAs sell this much stock in the next week.
What are CTAs?
Commodity Trading Advisors. So they basically go with the trend. I don't know. Whenever I see that, Abigail, I'm always like, that's just an excuse.
Yeah, I think that it's funny you're saying that. A lot of the headlines that come out, whether it's that or management saying various, providing various narratives, I often think that it can be an excuse for what people want to say. At the end of the day, it comes down to the U.S. corporate profit outlook. And so, again, to the point of earnings season, what will that look like? What will the guide be on the year? I think that companies are pretty inconsistent in terms of the story. Some are pretty positive. Others are a little bit less positive. We talked about this yesterday, Alex, and this is like a small part of the market, but Ulta Beauty yesterday saying that all of the strength that they've had for beauty buying for years and years now, during the pandemic, because people were on Zoom, and out of the pandemic because they were back out, all of a sudden it seems to be drying up on what they're calling, I think it was a consumer soup of uncertainty or something. That was the broad, and that's a fancy way of saying that consumers are finally concerned about inflation, geopolitical risks, all these different factors that we've been talking about. If there are additional companies that come out during this reporting season that suggest that 2/3 of the economy could be a little bit weaker, that could be interesting for stocks. On the other hand, who knows? Maybe the impossible will continue to happen. Sometimes these things go much farther and further than you think. And I would say Fed Chair Jay Powell really seems to want to support a boom for stocks, a boom for commodities right now, despite some of the data, despite some of the people coming out disagreeing with him, looking at the fundamentals, saying that they're going to cut 3 times this year. Let's see. Although I love that the Fed is always conditional logic. If this happens, I mean, you could have looked at some of those statements yesterday. They basically crossed him out saying nothing, but his tone in the Q&A, I would say, was more dovish than not.
Yeah, and one of the other areas that you look for the health of a market is IPO market, and Bloomberg's got a nice story out today. Ryan Gould reporting from our markets team. The U.S. IPO engine looks ready to speed ahead in second quarter, and I guess that's off the back of some pretty good IPOs in the first quarter, Astera Labs, Reddit, that type of thing. So I know that's a lot of market observers view a strong, new issue market, strong IPO market as maybe confirming about the strength of the market.
Yeah, I think that's correct. I mean, it would suggest that there's enough demand out there, enough appetite for the riskiest shares that banks and companies are willing to do so. On the other hand, you could take the other look at it, because I always remember 2006, 2007, when you had a lot of companies cashing out. I think, in fact, Blackstone went public at that. I could be wrong on that, but I think that's when they went public. And afterwards, I was reading somewhere that, it was a tell, and that they kind of saw that there was something ahead and they wanted to cash out in advance. So, it's hard to say exactly what's here, but on first blush or first glance, it would seem as though that's a positive take on the markets.
All right, Abigail, thanks so much. Really appreciate it. And just to add to that Ulta Beauty story, Lamb Weston, packaged food company, Paul, cutting its full year sales and profit forecast. Now, part of it might be idiosyncratic because it's transitioning to a new enterprise system, but still, interesting to see, and that's not getting hit pretty hard, down about 15%. Another stock that we're watching today is Disney. Shares are up by about 0.6% after Bob Iger prevailed yesterday in the shareholder vote meeting. Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media, is standing by for us. Geetha, what did we learn yesterday about Disney and Mr. Iger?
Yeah, definitely a huge sigh of relief for both Bob Iger and the management team. I mean, it would have been, I think, a very, very publicly embarrassing thing for him if Peltz had won. So this is definitely, I think, gives them something to cheer about, at least in the near term. But other than that, Alex, I think it's really business as usual, right? They have their work cut out for them. They know exactly what they need to do, whether it's finding a proper, good ESPN digital strategy, whether it's getting the streaming business to profits, and more importantly for the board, whether it's chalking out a really bulletproof succession plan this time around.
And on that succession plan, is the expectation, Geetha, that they will hire from within, or will they try to make a big splash by hiring an outsider? How do you think Disney would like to proceed?
Disney has always kind of looked within, Paul, and you know this well. I mean, the last time that they went external was back in 1984. That's when they hired, Michael Eisner, right, the Barry Diller protege. But after that, it's always been internal, right? Whether it's Bob Iger. I mean, it was Bob Iger after that for almost 15 years, and then of course you had Bob Chapek for a couple of years, and then we have Bob Iger 2.0. Back again. So they've always kind of had, more. They've always looked internal, and they do have 4 solid candidates. So all the division chiefs kind of emerging as potential successor candidates. It's just going to be up to how they groom them. Is Bob Iger going to do something very similar to what he did with Tom Staggs and Jay Rizzullo, kind of have that COO position for somebody whom he's kind of looking to elevate?
What's the time frame here, Geetha, for this?
It has to happen pretty quickly, Alex. I mean, Bob Iger's term, which was initially when he came back in November 2022, was supposed to be 2 years. They extended that out to 4 years. So we have until the end of 2026.
Yeah, and he's been known to Extend.
Extend,
And,
yeah.
and he can do that because most shareholders are like, hey, Bob Iger's better than anybody else out there. We'll stick with that. All right, so Geetha, things seem to be settling down, a little bit of stability returning to Mickey Mouse. How about at Paramount Global? It's almost the opposite there. The stock is down 6.6%. Are they going to sell the entire company, parts of the company, super voting stock? What's going on there?
Yeah, so it looks like now they have, or they've entered this period of exclusive talks with Skydance Media. And Skydance Media has kind of been, this on again, off again interested party in the Paramount company. But of course, they didn't want to come out with a bid for the entire company, at least up until this point. They always kind of wanted to do it in a slightly different way by kind of taking control of the voting stock through National Amusements and the Redstone family. Now it looks like they're kind of going to engineer like a two-step process where they first take control of National Amusements and then go about and merge Skydance with the entire company, with Paramount. So still, I mean, there's just more unknowns than knowns at this point. There seems to be some report out there suggesting that they would need to do an equity deal raise of at least $3 billion. That's going to be really dilutive for the current shareholders. Again, we don't know exactly how much Sherry Redstone is demanding for her voting stock. There are rumors out there suggesting it's upwards of about $2 to $2.5 billion. She also owns about close to almost $1 billion in economic stake in Paramount. So again, too many unknowns right now, Paul. But we do definitely have concrete talks. That much is for sure.
So is the Apollo thing like off the table, right? Because that would be more of a piecemeal approach to Paramount, right? Even though the cash deal was better.
So the Apollo thing was actually initially it was piecemeal, but they only were really interested in the film studio. They did not want the TV networks. They did not want the streaming asset. But it looks like yesterday, when reports emerged about the Skydance deal, they said that Apollo actually had made a $26 billion offer, an all-cash deal for the entire company, which Sherry Redstone, for some reason, basically said no to.
Wow, because I'm looking at the enterprise value today, about $23 billion, so it would have been a little bit of a premium there. And boy, you know who looks smart is the guys at News Corp. I mean, selling their company, several years ago. Just the Murdochs. They look kind of smart here. So, what's the future? I mean, this is the Paramount studio, Geetha. This is one of the prized jewels in Hollywood. I mean, what happens to this company? I mean, is it going to remain a publicly traded company? Is it going to be taken private? What's the most likely outcome?
I think the most likely outcome at this point, Paul, is that it still very much remains a public company. We know that David Ellison is really only interested in the studio portion of the business. And you're absolutely right. It's an iconic studio. There's no doubt about it. They have a very, very valuable studio lot right in the heart of LA. That's worth maybe upwards of $1.52 billion. So obviously there's a lot of assets that he likes, but only with the studio business. So again, the question is, yes, he can keep it a public company, but he might really kind of trim it down, try and find some buyers for the TV network, for probably the streaming platform, and just make this like a pure play kind of a film studio with, production and licensing operations, very similar to like what Lionsgate is doing.
Mm-hmm. Would that command a valuation, like a good valuation for that, if they did that?
So we do know that Apollo came out with $11 billion offer. That's a pretty decent. It's about a 13.5 times EBITDA valuation, which is pretty much in line with where other pure play studios are trading. So probably yes, somewhere in that range.
All right, we got you here. Let's ask you about Warner Brothers Discovery, off another 1% today, off 24% this year, down 43% over the last year. Any scenario there that is worth kind of looking at?
I mean, it's been all doom and gloom at Warner Brothers. And really the one metric I think that people are like fixated on for Warner Brothers is EBITDA. You know that when the deal actually went through, or when they were looking to merge those two companies, they spoke about $14 billion in EBITDA. This year, probably we're not even going to hit $10 billion. And that's really why investors are so upset. Combine that with over $40 billion in debt, and that's a recipe for, the doom and gloom. And that's exactly what's happening there. So until we kind of get some better metrics, it's not going to look good.
You know who bailed on the media industry at the right time?
You?
Me.
Yeah.
Exactly.
I mean, I am going to see Dune 2.
Well, you're kind of in it right now.
Yeah, I'm kind of in it, but my livelihood, well, it does kind of, I don't know. But, you know, it's just...
This is an excellent point.
Yeah.
This is an excellent point, John Tucker, that you just went from the other side of the media business.
Exactly.
I'm seeing Dune 2 on Saturday, so I feel like I'm doing my part.
Dune 2? Okay,
That's
good.
right. I'm doing
Excellent
my part for Warner
movie.
Brothers.
Excellent movie. Some Geetha, she knows.
Excellent.
See, she
Excellent
knows.
movie. It is absolutely brilliant.
I like Paramount Plus because of the whole Survivor thing, because I'm addicted to Survivor. So, you know, I'm helping. I'm doing what I need to do.
All right, Geetha, thanks so much. As always, Geetha Ranganathan, she covers all the media stuff for Bloomberg Intelligence based down in Princeton. Dune 2, I didn't see Dune 1. Do I need to see Dune 1
You
before I see it?
absolutely do. And you probably need to see it 2 or 3 times because I didn't get it. I had to watch it twice. I was like, what's this movie about? Or you can read the book.
Really? Sand.
There's lots of sand. But it's very much like parallel to like oil stories.
Oh,
which
there's
is kind of my in there.
I understand. All right, we're going to have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. We're being brought to you by Interactive Brokers. Discover the future of trading with their next-generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. Data in the driver's seat again. Fresh tally of U.S. jobless claims ahead of Friday's March payroll report. They're creeping higher. The weekly jobless claims up the highest since January. Kind of the bad news, good news scenario. It suggests the Fed does have another reason to go ahead and cut rates, maybe as soon as June. And, of course, risk assets like that. Treasury yields lowered to unchanged. Going into the first quarter earnings season, first quarter S&P 500 earnings projected to rise 4.1% year over year, but actually fall close to 2% when you exclude the Magnificent Seven stocks like NVIDIA and Microsoft. Enphase Energy, best performing stock right now, the S&P 500, up close to 7%. And then you have Lamb Weston Holdings. That is the worst performing stock in the index right now, down close to 17%. They cut their sales and profit forecast. Overall, the S&P 500 up 33 points. That's a rise of 0.7%. We're at 52.45 in the index. The Dow Jones Industrial Average up 138 points. That's a rise of 0.4%. And the NASDAQ 100, 130 points higher, up 0.7%. And we check the markets all day long, right here at Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. I'm Alex Deal alongside Paul Sweeney. This is Bloomberg Intelligence on radio. You can also check us live on YouTube, but we are live in the Interactive Broker Studio right here in Midtown Manhattan. Let's stay with energy for a moment. So Green Plains is basically an ethanol company producer that wants to become an ag tech company. And the CEO is taking this very seriously and doing a lot in the middle of this transition. The stock is down, though, 23% in the last year. It is up about 2% today. And we welcome the CEO and president, Todd Becker. He joins us now from Omaha, Nebraska. Todd, it's always good to talk to you. What I love about talking to you is you just give it like it is. And you saw this shift from ethanol into something else before really anyone else did. And the idea is, look, you mix ethanol with gasoline, but if we're all driving EVs, do you really need the ethanol? How's it going? How's this transition for you going?
It's actually going really well. I mean, thanks for having me again. I love talking to you guys. And, you know, everything that we've laid out so far is on track to get to 2025, which is when we said we're really going to be able to start operating on all cylinders, no pun intended. But look, I think our base fuel still has strong demand, but there's other value that we can unlock in everything that we do, and there's so much technology out there. And we just announced a great collaboration with Shell, a joint venture that we just basically had a grand opening ceremony that really just takes us next level on what we're doing in ag tech, because they, as much as they are one of the largest energy companies in the world, they also have a really interesting view on agriculture and technology, and combining what we can do in energy with what we can do in agriculture. And we've just kicked off an amazing partnership that we've been building for several years. So a lot's going on, and we're really excited about what's happening.
All right, can you talk to us about this joint venture? Because when you mentioned Shell, that gets my attention when I'm thinking about kind of biofuels companies like yourselves kind of getting together with traditional energy companies.
Yeah, so look, what Shell's looking for is more low-carbon feedstocks. That's the most important thing to them. And what we're looking for is more low-carbon ingredients for food and for feed. And so we have this technology. We bought a company a few years ago, which we think is one of the leading ag tech companies in the world, called Fluid Quip Technologies. And they have a separation technology that basically just puts something into their machine and it separates it out into all really interesting ingredients. Shell, on the other hand, had a chemical process that basically unlocks what's left on different parts of agricultural waste or fiber or anything that's getting processed that we couldn't go after to start. And when we put these two together, basically we can combine their chemical process to liberate oils and proteins and other things that are stuck on sugars that are stuck within processes. And then we take it from there and we can separate them all out. So it's really an amazing technology collaboration. We want it so we can get more sugars and proteins. They want it so they can unlock more from the standpoint of vegetable oil so they can make renewable diesel and other things like that, as well as the last part of it is that we could finally unlock the sugar that's stuck within the fiber, and that's cellulosic sugars. And for years and years and years, people have been trying to crack this code on cellulosic alcohol and fuels and that dream that people have had. And this is one thing that potentially unlocks that whole dream of getting every piece of value out of every piece of that corn kernel. And the great thing about this technology is it's just not limited to a single commodity. It's actually agricultural feedstock agnostic. You could drop a lot of different things in this technology. So we think it revolutionizes agricultural processing, if it works, of course. It revolutionizes agricultural processing globally, biorefining globally, unlocks all of the value of what we do in everything from food and fuel and feed.
Yeah.
And it's the first time, really, we think that a major agricultural company or one of the first times a major agricultural company and a major energy company get together to use everything we do to make all of the different products that we need.
So, Todd, it does sound amazing, and I like the idea of like liberating all the parts of the corn. It's a great phrase. It's a twofold question for me. When you get the stuff from that, what do you use it for? And how expensive is it to sort of ramp and scale all this up?
The great thing is that over the last several years, as we've been transforming our company, we've deployed about $350 million to $400 million in the separation technology already. So we're already using it. So our technology is proven already. So we've put it at several of our facilities and joint venture facilities. So we are already beginning to separate most of what happens in a kernel of corn and other products. So what this does, you lay this over it, and it's all the remaining things that we can't get. They can get it chemically in their processes. We just could never get it that way because that's not what we did as a company. So the cost, we're hoping, because we've already deployed technology at 5 of our sites, which is 6 coming on today. When we overlay this technology on top of it, we should be very cost efficient. The first one, we built it under, really, nobody really knew what we were building, but in York, Nebraska, we already have the first build that we've been spending years doing quietly under the radar screen, putting our technologies together, and we're going to start that up in about a month or two. And that's really what we had our grand opening and our announcement on. It was just a very quiet collaboration. But really what it does, it extracts everything available. So we leave corn oil when we send out our fiber. We can go after that. That can be used in renewable diesel and sustainable aviation fuel. We leave sugars on our fiber that goes out as animal feed. We can go get that, which can be made into cellulosic second-generation low-carbon ethanol. There's more protein to go after. We send out very low-value protein still. This technology together unlocks ultra-high protein that we're already shipping to pet food and salmon producers around the world. It just gives us more. And then lastly, what we're able to do is take all of that and think about low-carbon alcohol for things like sustainable aviation fuel that's going to be coming down in the future, because the only true path to volumes of sustainable aviation fuel is going to come through alcohol.
So, and I'm assuming, so if it's cost competitive, if you overlay the technology and it's at cost for you guys, it doesn't raise the price of the product that you're then having to sell?
No, actually, we're just able to unlock more. We're sending it already out as everything left we send out as a more of a lower value product. So it unlocks all of that. And now what we can do is actually make great products and much higher values for what we're going to produce than what we're doing today. And the most interesting thing about this technology, Alex, is I can either drop a corn, to the basic of it, I could drop a kernel of corn in there, but I could also drop a soybean in there and blow up and chemically separate that and really disrupt what's happening potentially in soybean processing. Or I can drop a kernel of wheat in there and go unlock all of the protein and the oils and the sugars and all of those things that nobody's been able to go after in any kind of really efficient way.
So Todd, if I'm looking at your stock, it's up 10% almost since that announcement, but it's not had a good full year. And I'm wondering, when do you feel like you should be getting credit for this? And I know you're going to say yesterday, but you know what I'm saying.
Look, when we started our transformation, the stock was 8. It ran up into the high 30s. Now we're back down. We brought a couple of reasons I think we're down a little bit this year is, well, not a little bit, but we brought our MLP in, so we wanted to clean up our capital structure. So we were able to bring that in, and we handed our shares to MLP shareholders that they were earning a pretty high yield, and I think that put some pressure on our stock, as well as we've seen some drops in prices, and ethanol is trading $1 under gas, so now we're getting more competitive again. But we really saw a drop in vegetable oil pricing here recently, but now that's starting to come back, which I think is putting a bid back into our stock as well. So we're about a year. What you said is our path to 2025. 24 is our transition year. We need to deliver on some financial results this year, and I think we're going to be able to do that as the year progresses. But we've made investments, and the whole sector really kind of fell out of favor anyways, and I think we got dragged down with that. Well, we have a great technology. We have a great platform. We've got great products. We're going to start our first, and I know we talked about this a few years ago, our first clean sugar facility. We're going to make food-grade dextrose for everything from gummy bears to seltzer drinks. That's never happened in the history of our industry. We're starting that up next month and later this month as well. So there's a lot going on. We're right towards the back end of what we said we were going to do, and now it's starting to all come to fruition, you know, and the pressure came across the whole sector. If you look across the whole sector in agricultural processing.
You finally said the word that got John Tucker here in the studio excited. You said gummy bears, and all of a
Well,
sudden
I was
he perks
writing.
up.
I got distracted. I'm
You got
sorry.
distracted.
But, you know.
Ethanol, whatevs, okay.
This is like
Liberating
oil in
corn
those gummy
is
bears?
fine, but you know, gummy bears, no sugar. He was paying attention. Hey, Todd, really appreciate it. Always good to catch up with you. Todd Becker, President and CEO of Green Plains, joining us from Nebraska. You're looking at S&P up by about 0.6%. Let's go to Michael Barr for World and National News. Michael.
Thank you very much, Alex. John, President Joe Biden and Israeli Prime Minister Benjamin Netanyahu will speak today over the phone about the deaths of food aid workers in Gaza. It comes as World Central Kitchen founder Jose Andres says Israel's war against terrorism has become, in Andres' words, now a war against humanity. Andres spoke to Reuters about the attack by Israel that killed 7 of his aid workers.
What I know is that we were targeted deliberately, non-stop, until everybody was dead in this convoy.
Israel insists it was a tragic mistake. Meanwhile, navigational signals were scrambled over the Tel Aviv metropolitan area today as Israel braced for a potential Iranian attack on the country's economic center. Tensions have soared since Monday when an Israeli strike on an Iranian diplomatic compound in Syria killed senior Iranian military officials. The death toll is 10 from Taiwan's strongest earthquake in a quarter century. More than 1,000 others are hurt. Rescuers are racing for a second day to reach more than 600 miners, hotel workers, and tourists trapped in high terrain around the epicenter in eastern Hulain. But it could have been worse, as we hear from Bloomberg News senior editor Bill Ferries in Singapore.
The economy seems to be getting back on track. You heard from TSMC, one of the world's most important semiconductor chip producers, that they are getting their operations back online. We do expect to hear at some point an impact in terms of their deliveries and sales, but that will be pretty limited given how quickly they're able to get these factories going again.
Bloomberg's Bill Ferries. The Powerball jackpot has increased to an estimated $1.23 billion after another drawing last night without a big winner. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash ahead of tomorrow's jobs report. Tech companies driving gains right now. You have Microsoft and NVIDIA leading gains in the mega caps. Treasury yields, they've retreated after the latest economic data. We had initial jobless claims ticking up to the highest since January, so that's considered to be Fed-friendly. But Cameron Dawson at New Edge Wealth says, you know what, rate cuts from the Fed may not happen anytime soon.
We don't think necessarily that the data supports the Fed moving to cut rates swiftly. However, Powell certainly wants to leave the door open, which is likely why markets are taking a little side.
Right now, the S&P 500, 34 points higher, up 0.7%, 52.46 on the index. The Dow Jones Industrial Average down, up 163 points. That's a rise of 0.4%. We're at 39,292 on the index. The NASDAQ 100 right now up 140 points. That's a rise of 0.8%. Ford says it's delaying the rollout of an electric 3-row sport utility vehicle by 2 years. That extends the layoffs of 2,700 workers in Canada who are set to begin building that in 2025. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, John Tucker, thank you very much. So every day, Bloomberg has a big take where they really dive deep into a topic and a story, and they're quite good. And there's a podcast, and it's a written piece, and I highly recommend that you check it out. And the one today is particularly interesting. The title, Hubris at Hertz, doomed its massive bet on 100,000 Teslas. It's basically the rise and fall over the last few years of Hertz and its relationship with Tesla and EVs. Eric Schatzker and David Welch responsible for this article. We have Eric Schatzker, who is now Bloomberg New Economy editorial director, joining us. It was a great piece, and there were things about Teslas that, like, I didn't know were problems. Like, if you don't know how to drive it and you all of a sudden put the pedal to the metal, you go really fast and then you crash. Like, these little details I found so interesting. Walk us through what you learned and what the piece is about.
Well, you just touched on one of those things, Alex, which is that the experience of a Tesla owner is very different from the experience of a Tesla renter. And going into this big bet on 100,000 Teslas, they placed an order for 100,000 Teslas, in fact, back in 2021. The new owners at Hertz didn't appreciate that. There were no data, to be fair, on what it was like for a rental car company to have EVs in the fleet because none did. Hertz was going to be the first. And so they did look at the data. How do Teslas perform when they're owned by individuals? And generally speaking, Teslas perform well. They don't require a lot of maintenance. Obviously, refueling the car, so to speak, is a matter of plugging it in. But if it's your Tesla, it probably sits in your garage, or it sits in your driveway, or maybe if you live in a city like New York, it's at a parking garage and you've had a charger put in. That's all fine, and these people tend not to get into a lot of accidents, and they don't have range anxiety because they own the car. They made the decision to buy it. It's a totally different story. When you get off of a red-eye flight and, you know, stroll up to the Hertz counter and are told that, no, I'm sorry, the car you reserved is not available, but we're giving you a Tesla. If you've never been behind the wheel of an EV, it can be a terrifying experience. You don't know. You don't want to have to find a charger in the wild. You don't know what this instantaneous braking is like.
You don't know how to turn on the car.
You don't realize that it has rocket-like acceleration. And as a result, Hertz, with its Tesla fleet, started running into all kinds of problems. They were crashing, and it's very expensive to repair a Tesla. In many cases, they have to be junked because insurance companies are worried about the damage that might have occurred to the battery. People didn't want to rent them, so the demand wasn't there. And then, of course, Elon Musk cut Tesla prices by 30% and kind of blew a hole into Hertz's balance sheet.
Economic model. How did Hertz get into this position?
It's a good question. This was a rental car company, the only major rental car company that went bankrupt in the early days of the pandemic.
I'm a Gold Circle member of Hertz, by the way. I just stroll right up to my car, John Tucker.
Some people have very good experiences with Hertz, including Paul Sweeney, evidently.
Yeah, you got a Tesla.
So Hertz went bankrupt. It was bought out of bankruptcy in June 2021 by two professional investors. Tom Wagner runs Knighthead Capital, and Greg O'Hara is the founding partner at Certares Management. They raised $1.5 billion fund. They wanted to find travel and leisure companies that had been crushed by the pandemic, but of course, which in theory would soar once the economy reopened, and Hertz seemed like a great candidate. And actually, that part of the thesis played out perfectly. Once the economy reopened, in fact, before the economy reopened, when people realized getting into a car and driving somewhere doesn't put me at risk of COVID at all, demand for rentals went sky high. And so coming out of this acquisition from bankruptcy, Hertz was crushing it, but they had a transformational plan to turn it into a largely electrified rental car company. And that's where everything went pear-shaped. I talked about it, the demand, the damage, the price cuts. And we say it's a tale of hubris because in many respects it is. Of course, everything looks clear in hindsight. It did sound like an incredibly good idea at the time. And I think for the sake of the planet, it would be nice if you could electrify a rental car company and save, you know, the environment from all the gasoline that gets poured into rental cars. But it just doesn't work in practice. And whether it's arrogance, whether it's hubris, whether it's blind optimism, it could be a combination of all those three. These new owners, these professional investors, one who runs a hedge fund, the other who runs a private equity firm, thought that they had an answer for this industry that the industry itself had ignored for years. And the truth of the matter is running any company in any industry is tough, right? It requires some experience, maybe.
And the funny thing is, well, not for them, but is that they could be right, just either a little early or a little late, depending on how you look at it. Like making,
you know, whenever we talk about early, right, it's the broken clock thing, right? Broken clock is right 2 times a day. In the case of being early,
I thought it was a great strategy when I first heard it.
It makes a lot of sense.
It just sounded, it hit so many buttons there. But I guess it kind of goes to the bigger question, which we asked the auto industry writ large, is have we seen peak interest in EVs?
But this is why I found the article so interesting, because there were things that I didn't think about in that they don't have dealerships, right?
No.
So they don't have a relationship with dealerships. So like when my Subaru tire gets, you know, messed up, we just drive it in and then they fix it and then we drive out kind of thing. You can't do that with a Tesla. I never thought of that, for example. I never thought of how difficult it would be to all of a sudden get off a plane and go sit in a Tesla. It's weird enough getting in the morning to a Tesla and getting in the back seat. I can't imagine just being shoved into the front seat and having to drive it at the same time. And these little details I found to be very provocative.
well, they are, as you say, something of an indication as to why demand for EVs right now is slowing. Hertz, you know, we can play on the fact that it even has yellow as part of its logo, was the canary in the coal mine for the EV industry.
True.
What began to happen at Hertz is what the rest of the industry is beginning to wake up to, that all of the EVs that are being cranked out right now may not have a natural buyer because aren't enough chargers out there. People haven't gotten over this idea that it's a different driving experience. People, as we all know, are very personal about their cars, right? It's an extension of themselves, and you don't want your arm to feel like it doesn't belong on your body, and that's in some respects how people feel about getting behind the wheel of an EV.
30 seconds left, Eric. If I wanted a Tesla from Hertz tomorrow, could I get one, or are they just...
You can. They are beginning to sell down the fleet, though. They had 60,000 EVs. They've put about 20,000 Teslas on the market. In fact, if you want to buy a Tesla, now is a great time to buy one used. In fact, even off the Hertz website, because they are
like
way cheaper than
they've
ever been before.
All right. I tell you, folks, this is great stuff. Big Take stories, we love them. We love to support the Big Take reporting because it is deep, really cool stories and really cool, well-researched, well-sourced articles. You can read the Big Take stuff, Eric's story today on all the Big Take stories on the terminal. Plus, you can go to Bloomberg.com/Big Take. You can get access there. Eric Schatzker, Bloomberg New Economy Editorial Director. We appreciate getting you into Bloomberg Interactive Broker Studio. Great story, great reporting, folks. Check it out. Tesla, Hertz. Great story. We'll have more coming up. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom to look at some of the company stories we're following for you. Google considering charging for a new premium feature run by artificial intelligence. So this marks the first time it will put any of its core products behind a paywall. The Financial Times reports the tech giant mulling options such as adding certain AI search features to its premium subscription services. Now, Google's search engine, that will continue to be free, and ads would appear alongside search results even to subscribers. The engineers are developing the technology to roll out the service, but executives, they haven't decided whether or not or when to launch it, according to the FT. Sanofi has agreed to settle approximately 4,000 lawsuits. They accuse the French drug maker of selling its Zantac heartburn medicine without warning patients it could cause cancer. The pact is the first major resolution of cases related to the product. So the settlement should help smooth out the jangled nerves of investors concerned about the fallout of multiple legal challenges to Sanofi and others who made the medicine over the years, including its developer, GSK. Sanofi said it continued to believe that the claims don't have merit and that it reached the settlement to avoid the expense of litigation. Oh, we could do this. Planters Peanuts, owned by Hormel, looking for drivers to cruise in its Nutmobile. 3 people will fill the position for a year from June to June of next year. USA Today says the lucky 3 will be affectionately known as Peanutters. Not only will they escort Mr. Peanut across the country, they'll also do this while driving the 26-foot-long Nutmobile and planning events. The ride should be as smooth as peanut butter, and they'll also try to avoid getting into traffic jams. That's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. I'm Alex Steele alongside Paul Sweeney. We almost made it to Friday. You're listening to Bloomberg Intelligence Radio. We are broadcasting live from our Interactive Broker studio right here in Midtown Manhattan. You can also check us on YouTube. We cover all the top stories with our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries all around the world. We also bring you world and national news with Michael Barr. Michael?
Thank you very much, Alex, Paul, and John. President Biden speaks by phone today to Israeli Prime Minister Benjamin Netanyahu. It will be their first call since the deadly aid worker attack in Gaza that prompted some of the president's harshest words yet against Israel's handling of the war with Hamas. Bloomberg government's Jack Fitzpatrick has more from Washington.
There was this statement by President Biden on Tuesday saying he was outraged and heartbroken by the deaths of the World Central Kitchen workers who were